Like it might be another one of those data points that the market just looks right through.
Yeah, but we're on.
Seems to be where we are.
So this is the last big data point before the Fed.
Yeah.
So at some point, is this the last one? And then you've got to kind of make a decision whether or not actually those dots could potentially move. We did see Nova down yesterday. We did see ASML down yesterday. Let's see what moves first thing this morning. We're now open here in Europe. Novo bounces back. I already see it up by 0.7%. So that didn't last long. Is that an indicator maybe that the growth narrative comes back onto the front foot? It's kind of this huge growth versus value trade in Europe. Value definitely underperforming. So any dips seem to be getting bought. So Novo is already up. ASML is bouncing back. LVMH weakness yesterday coming back as well. So that weakness we saw in the growth stocks yesterday certainly reversing at the get-go of trade this morning. Some of the miners look a little bit soft already out of Europe. So a little bit of a reversal maybe in the pattern that we saw yesterday.
Yeah, and absolutely worth watching the mining sector because there's some quite conflicting trends going on there. Copper has been rising to an 11-month high. Capacity cuts over in China, part of the story there. But is that upside capped by concerns around Chinese growth? And then on the steel side, we've got a different story. US steel prices under considerable pressure yesterday. The stockpile story adding into there, and the concern around protectionism within that space, very much part of it. So there's a lot to think about when it comes to the mining companies and copper and steel moving in opposite directions through the Asia session.
Now we should mention what are copper, what are steel used for? Defense comes to mind. We're waiting for Rheinmetall to open as well. But BAE Systems already out of the gates higher by about 0.3%. That's going to be one to watch. We should also mention, by the way, the ABA InBev shares are suspended in Brussels. We're waiting for a statement there. So we want to kind of see what's going on there.
That's a big stock to be suspended.
It is. I wonder what it's about. It looks like a statement coming from the FSMA. So we'll see what the read-through is there. But it looks like Jeffrey's already coming out and saying that some of the shares were facing volatility. This comes after Altria in particular sells that stock.
Yeah, we saw this news was late yesterday, wasn't it? Altria planning to sell more than $2 billion of AB InBev stock. And so we sort of, that news is in the market. Maybe we're waiting for some kind of a further statement in our time zone.
I'm always interested to see how stocks react to this news, because in some way you're removing an overhang.
Yeah.
And in that sense, that is positive. There's always been this expectation that maybe the stock does get sold, so maybe that's a positive. But that's an awful lot of stock.
Yeah, now, this news came from Altria around 8 o'clock our time last night, so they came from the US side, so maybe we're waiting for something out of Europe on that front. So that's one of the stocks in focus. Rheinmetall, as you say, another one that we're waiting for, playing into the broader defence themes, and obviously this is a business that has been benefiting, sadly, from the war in Ukraine, so that's something that we're watching. Sales hitting 10 billion euros as Europe arms Ukraine.
And as we, of course, get those opening prices, I want to get a quick check on those U.S. pre-markets as well, because we are starting to see potentially see some movement there as well. Apple at the gates, higher by 0.3%. Is that, we call it the Apple effect on high, but is it the on-high effect on Apple? If you see net income beating there, does that mean more for Apple, despite the fact that they're actually saying most of their income comes from the AI trade? We also are looking for that HPE initial read-through, even for Lennar, not seeing those initial reads. But again, it is, I believe, 4 a.m. in the States right now. Very light volume. We're going to get a quick check on that later as more and more trades come through.
Absolutely. Let's talk. We've talked about the defense story already. I think it's fascinating to see how this sector has changed in perception. We never talked about defense stocks. It was an area that we very rarely focused on, or certainly have done over recent years. The peace dividend has basically put pay to that. These are companies that have really sort of struggled and have had long cycle kind of businesses. Now that situation has clearly changed as geopolitical tension sort of rips across Europe and across the Middle East, and we're seeing big defense spending in the United States as well. Does that continue? Rheinmetall is one of the cases in point. The company out this morning saying it expects sales to grow at around 10 billion euros this year. This as European military spending, clearly, and the war in Ukraine, amalgamated, drive the German arms maker to significantly higher profits. This is a company that makes the Leopard tank. This is a company that makes howitzers. This is the kind of kit that is being used in Ukraine. Oliver Crook joins us now from Germany to take us through the numbers. What can we read into the initial numbers that we're getting from this company? What are they telling us, particularly about the outlook?
Yeah, Guy, we can say that there's another record year and that there are all these numbers, but I've tried to kind of put this into context for us to understand kind of the scale of this. So I looked at the full year from 2021 before the war versus the full year that we got for 2023, and it's pretty interesting. So we look at just sales for 2021. That was a record year already for Rheinmetall. That was at 5.7 billion euros. This year coming in north of 7 billion. You look at the margins, it's a similar story, around 10% back in 2021. We're talking about almost 13% now. And this, what I think is critical, because this throws us into the future, is the backlog of orders, right? It was about 25 billion euros back in 2021. We're looking at almost 40 billion euros worth of material there. And when you look at the stock performance, again, for another sort of look at the context here, Rheinmetall is by far the outperformer versus other defense stocks in Europe, other defense stocks across the world. It's up almost 400% since the beginning of 2022. What's interesting is it is actually the single best performing stock on the Stock 600 from that period of time. And actually, if you look at the MSCI World Index, it is the second best performing in the world.
Okay, and can this kind of demand hold up then, Ollie? I mean, clearly nobody knows how long the fighting continues in Ukraine, but what are we hearing?
Exactly. So we look at some of the projections that they had going forward. So they're saying for this year, as you mentioned, you know, we had sales last year of 7 billion. We're expecting now 10 billion to happen. They want the margin they see going up to maybe 15% this year. 2026, it may hit 14 billion in terms of sales. But this is exactly the question that Guy put to the Saab CEO when we spoke to him last week. Even if there is peace in Ukraine, which again seems like a distant process right now, what does that mean for the defense spending? What are your assumptions? Have a listen to what he had to say.
The projections from independent sources on the defense spending over the next decade from European countries, that increased by $500 billion from January 23 to January 24 in terms of projection in the next decade. I have a hard time seeing that if we hopefully win the war in Ukraine and we get peace, to just sort of let the guard down again and hope that nothing will happen, having Russia as a neighbor for decades to be not trusted. I don't think that's possible.
So we're talking about $500 billion of spending potentially over the next 10 years. And when you think about that, all the structural forces that are supporting that spending, the other thing here is about NATO spending and getting those numbers up in the U.S. election. And if the U.S. could step back, Europe is very concerned about being able to meet the demand for all of the capacity that they need to produce. And Europe is really wanting to buy things within Europe. That doesn't leave a lot of companies. That leaves basically Saab and Rheinmetall.
Speaking of that kind of demand that you were just referring to, let's talk about what kind of hiccups there might be in that EU leaders meeting next week. What effect might that have, not only on the demand story for defense, but their strategy around Ukraine?
Yeah, so we've been listening to a lot of news out of Brussels on defense, and the EU leader meeting next week, you know, front and center is going to be obviously the situation in Ukraine and how to support Ukraine in potentially the absence of the United States, where that bill is still stuck in the House and we don't know what's going to happen in terms of the election. And there's been, you know, escalating rhetoric from Trump about NATO and potentially stepping back, all those sorts of things. So that's obviously going to be, you know, high on the agenda. But again, Vestager has said that right now Europe is getting 80% of its military kit and spending outside of Europe. They want to get that to 50%. 60% of it's going to the United States. So how do you actually get there? And there's also this question of the funding gap, right? Where you have actually what has been promised. Promises are one thing, and the reality of it. The Kiel Institute has looked into this. Europe has made commitments of 144 billion euros to Ukraine. It has delivered and allocated only 77 billion of that. So there's a huge gap there. And then also thinking about longer term, if the United States were to step away entirely, in just this year, that means that Europe would have to double its military commitments to Ukraine, which again, on the question of capacity, is that even possible?
All comes down to the numbers. Ollie, really nice. Thank you very much indeed. Ollie Crook running us through the Rheinmetall numbers and the implications for the defence space. As he was mentioning, Rheinmetall has been a huge outperformer. European defence stocks have had a great run. The story, though, remains in Europe. What is happening with a core group of key stocks? We're calling them the sensational six, only because we can get six on the graphic. But here you are at the get-go of trade. That growth narrative is back in the market this morning. You look at what is happening here, and these are stocks that are going toe-to-toe with their US rivals. Novo tracking higher again. LVMH is up. Ferrari, ASML, Schneider. Schneider had a good day yesterday, and it's continuing today. Nestle continue to rise. If you want to talk about upside in Europe, this is the area you want to look for the drivers. These are the stocks that have been making those moves. So that's what they're doing this morning. What else are we watching? Joe Easton's got the details.
So here's the Rheinmetall move on the screen. You've run through the details there. So it is up 3% at the moment. We've got a bunch of other German stocks today, particularly in chemicals. Now, two very different stories here. We've got Lanxess down almost 10%, but K&S up 5%. Lanxess supplies into the end markets in terms of consumer markets like skincare and also pharmaceuticals, that kind of area. It is seeing weakness in their sales, but the one that's doing strong is K&S in agricultural chemicals, a very big split in the sales divergence there between those two firms. An interesting story for me this morning. Then Hapag-Lloyd, you mentioned earlier, what stood out to me was the guidance very much under analyst expectations. Revenue potentially only €1 billion in terms of that one. That one down 1% over in Germany at the moment. Then we'll flip over and have a quick look at the Polish grocer Allegro. That one doing well. Their earnings today showing some strength in pricing. The issue is all about whether the food prices come down, but not seeing that at the moment, so we are seeing that one higher. And Embracer, this is over in video games in Sweden, the best performing stock we've got today, the maker of Lord of the Rings video games, offloading a unit for around 250 million quid, according to a statement today. And a couple in the UK, Deliveroo, seeing some declines in their earnings. They are still reporting an operating loss, but that stock trading massively below the IPO price from a couple of years ago, so it's coming up. And AstraZeneca holding steady on that $1 billion acquisition that is announced today. In terms of share placings, it is share sale Thursday. You mentioned AB InBev currently in a trading halt, so we're waiting on a price as we see a big stock offloaded by Altria. All of these three firms also seeing investors offloading shares. Wise, Vinci as well over in France, the Qatar Investment Authority offloading shares in the Vinci airport operator. That was a bit of a controversial one. And Exane BNP selling shares in their Polish units. So BNP Poland slipping slightly. Just a couple of morning calls to bring you very quickly. We'll bring them up on the screen here. We had a couple of ratings out today. Here's Sanofi raised to buy at Stifel. You remember that had some weak earnings recently and a CFO exit as well, so potentially an opportunity to buy into the French pharmaceutical firm. And then the final one we'll flip over to on the screen is Logitech. This is the Swiss maker of computer accessories, headphones, earpieces, that kind of thing. Gets an upgrade to buy over at Berenberg. They see an opportunity there, and that one is up 1.4%.
All right, Joe Easton from our equities team, we thank you so much walking us through some of those key analyst calls that we are seeing this morning. And due to the time difference, it's worth hitting some of the U.S. pre-market movers as well, because a lot of it is a macro-driven story. Guy, Anna, one of the big ones I'm watching is Freeport-McMoRan, seeing the most volume this morning. And given it's only about 12 minutes into the U.S. pre-market trading session, but this, of course, a massive copper giant, higher by about 1% this morning. It was higher by much more, again, just a couple of minutes ago. So a lot of that comes from, again, a move that you're seeing in copper. It looks like the Chinese are looking to cut potentially on some capacity issues. That's going to feed into the likes of Freeport. That's one stock we're watching. The other, by the way, Tesla down 0.7%. The slide there continues.
Yeah, I was just looking, as you were talking about that copper player, I was just looking at Antofagasta. That's actually down a little bit in the London session, but another, not moving higher on the copper spike, but right to point that out. We mentioned it last hour, the fact that that Chinese move pushing the copper price higher, but a mixed bag when it comes to the mining sector this morning.
Yeah, I think it's really hard to... Chinese smelters are impacting the copper price, but the broader picture continues to be weakness out of China. But copper is a you think about the electrification story, it's kind of a big part of that. Coal feels like, iron ore feels like it's kind of old school industrial China. I appreciate the housing story relies on a lot of copper, but there's such huge demand, structural demand going forward for copper.
Yeah, although it appears that the issue around copper right now, or what they're doing right now in China, is collaborating in some way to restrict capacity, and that's what's pushing up the price. But yeah, is it limited, that upside, by some of the concerns around China, or is it boosted by the global trend towards electrification? All of those points, well made.
Yeah, it's going to be something that we're going to see if it kind of bleeds into the other sectors. It's not just a stock story, it's a bond story as well, right? We like to look at what the credit implications are. This feels like something you want to jump in on.
No, I feel we're kind of tap dancing around the big issue here, which is we don't know yet. These markets feel very cautious to me this morning. Everybody's waiting for that PPI, retail sales prints, a little bit later on. That's going to give us the kind of the real steer. If you are a PM this morning, are you really going to be brave enough to make some big moves here in advance of that data? I don't know. There feels like this is the last piece of potentially hot data going into that Fed meeting, and we don't know what's going to happen.
So we'll take a snooze until next week then, BOJ and the Fed.
Central Bank Palooza, isn't it? And then we have the BOE on Thursday
as
well?
So,
yes.
Palooza, that's a great word.
Yes, plenty to talk about in the rate space, but then again, how does that translate into the corporate credit space as well, when a lot of people may just be looking to refinance? Coming up, we're going to talk about just that. The global head of credit and equity and derivative strategy over at BNP Paribas Markets joins the program next. We're going to be talking all of the above. Stick with us. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
where do I land? So, there's soft landing, hard landing, softish landing. I'm kind of hardish landing. Okay. That is that I do think that there'll be a substantial slowdown in the second half of the year. Now, why is that? Because real interest rates have finally gotten positive for the first time in 20 years. They've only been positive for about 6 months. That is, the interest rate, the 5% or so interest rate, has been above the inflation rate only for about 6 months. Real wages are finally starting to grow in a positive way.
That was the former Fed governor and University of Chicago Booth School of Business professor, currently, Randy Krosner, speaking to the team in the last 24 hours about what kind of landing we get in the U.S. economy. Let's get another view. Victor York joins us, Global Head of Credit and Equity Derivatives Strategy at BNP Paribas Markets 360. Very nice to see you, Victor. Thanks for joining us. So he was saying a hard-ish landing, although there seem to be soft elements for the time being, hard-ish in the second half of the year. You see a credit soft landing. What does that look like exactly?
Yeah, I think we're in a credit soft landing, and what it means specifically is really low defaults, really low risk of credit downgrades. So a little bit to talk about froth in the market and so forth that you guys have been talking about this morning, and it's obviously something I completely agree with. The risk environment when you're in a credit soft landing tends to be pretty low. It tends to be these periods where volatility is really, really low, frustratingly low almost, and where the dips, and there are dips, they tend to be pretty shallow. And what it's really about is, the growth environment obviously fairly strong, but it's really the credit availability that's improving from the last couple of years. Rate cuts, they're a little bit part of this, but when you look at bank credit availability, it's improving. The share of lower-rated companies in the high-yield primary market, they're improving. That's really the sort of factor that's changing, and which means credit soft landing.
Okay, so that's all looser financial conditions coming ahead of an expectation of a Fed rate cut. We don't know when that comes, if it comes this year. The expectation, of course, is it comes in the middle of this year. We will see. One area of potential risk, though, so I'm listening to you, Victor, and I'm thinking, well, this all sounds like it's, quite positive for credit. Then one area I might be concerned about might be commercial real estate. How worried should we be about that subset?
Yeah, that's probably a subset that isn't in a credit soft landing, because it is heavily exposed to, for instance, office, which has its own structural problems, and where there will be a default cycle. And it may actually get worse because some of this weakness may spread to multifamily housing, which so far hasn't been that badly affected. So that's an area which probably will get worse, and rate cuts are not really going to change much there. It's much more a question of needing to inject equity in order to stabilize it. It will affect parts of the financial system. Peripheral German banks, for instance, are exposed to it, but it's probably not an exposure that's at this point wide enough to be a broader financial system issue.
Credit markets are crazy places right now. You're talking about you've got no default cycle, no downgrades. Why don't I just buy triple Cs, get my 12%? If you're saying that there's no change, material change, don't I just want to go down the stack? I want to buy the junkiest of the junk right now. That seems to be what's outperforming.
I think it's going to be a year where carry is king, and that strategy may very well work. I think the question is obviously, where can you, in this environment, where do you have the sweet spot in terms of, the impact of the level of rates on corporate credit? So we have a big maturity wall. Rates are about 200 basis points lower for the two.
Do we have a big maturity wall still?
We do have a big maturity wall, yeah.
Primary issuance is crazy right now.
Yeah.
That looks like a mirror. That maturity wall increasingly looks like a mirage to a lot of people.
I think, if we meet around this time next year, there will be maturities of around 170 billion every single month for a combined universe of U.S. and European corporates, investment grade and high yield. So that's still ongoing, and that means that you do need to avoid a material backup in yields from here. But at these yields, that looks refinanceable. The other thing about these sort of yields is that they're still much higher than where we came from, something that Janet Yellen has been talking about, and probably not going back there. And that also means that there'll be companies who are incentivized to actually reduce leverage over the next few years. And that's probably not the triple Cs, but it may be the double Bs and so forth, the kind of companies that took on a lot of risk under the ECB's and Fed's umbrella over the last few years.
But nevertheless, this big fear that we had at the beginning of this year about these various maturity walls that were going to hit us. January and February, every day I come into a headline of record primary issuance on both sides of the Atlantic. Particularly as you go further down, the issuance takes out a lot of risk. And I'm wondering how much risk still remains around those maturity stacks, given the level of issuance. Does the issuance carry on as it is right now? Do we continue to see this level of demand? We talk about frothiness. The demand for primary credit at the moment is epic.
The issuance will need to go on precisely because that maturity wall extends into 25 and then into 26. So it does need to be, a year of pretty heavy issuance. Also, remember, we're coming off of an environment where there was virtually no issuance and credit growth in general was really, really low. So there needs to be refinancing happening. Is there going to be demand for everything? There are pockets where the demand is secularly strong, European investment grade being one such area, for instance, where I think you've had an issue of, call it strategic underallocation over the last 2 years. Yields were close to zero. Nobody needed to own the asset class apart from maybe the ECB. And now suddenly yields go back up to 4%. It's a fairly defensive asset class. There is a huge reallocation into that part of the market. So that's areas where you can see issuance being high for the rest of the year and possibly into next year as well. Further down, when you get into the triple C space, it is much less clear because that is where it's questionable whether rates have improved enough so that all companies can make it.
What is that issuance being used for, though? Because we keep looking at a lot of these corporate earnings. Buybacks, dividends are a really big theme. Is this some sort of kind of deja vu of 2018, 2019, where you issue debt to fuel the stock market?
I don't think so. I think that this is an environment where actually we're going to see much more defensive type of corporate activity, more divestments than acquisitions, and much less to fuel share buybacks. Because if you look at how the cost of capital has changed over the last couple of years or so, cost of debt has gone up a lot, came back down obviously, but it's still pretty high. Cost of equity, not gone up as much. So compared to where we came from, if the trade used to be issue debt, buy back shares, now in some ways it could be the other way around. So I think we're looking at a much more defensive corporate environment. In spite of all the froth, I think corporates are going to be less frothy.
It's a very contrarian take, I have to say. Victor Hjort, we have to leave it there. The Global Head of Credit and Equity of Derivative Strategy at BNP Paribas Markets 360. A lot to dive in there. I'm sure Guy and Anna and I will have plenty of thoughts. But coming up on the program, we're going to dive into the UK a little bit. Price is steady in the UK's housing market, but survey reports there's a 3-year high for properties on sale. What does that mean, not only for the economy, but for the BOE going into next week, and of course, the markets? We're going to dive into all of it shortly. Stick with us. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. and they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
This budget, I would have liked to have had some measures that help people get on the housing ladder, but it is difficult to do that unless you are absolutely confident that property prices are back on the up, because otherwise you are encouraging people to get onto the housing ladder with the prospect of house prices falling and therefore then falling into negative equity.
UK Chancellor Jeremy Hunt there commenting on the UK housing market. A little bit of regret about things he couldn't do with his budget of a week or so ago. Sophia Horta-Acosta joins us now from the Markets Today blog, and we'll pick up on the housing theme. Sophia, very good morning to you. So the story this morning out from Rick's, UK housing market sees more buyers and sellers as prices steady. Is this telling us a positive story about the UK housing market, or is it only positive relative to last year?
Well, last year was a very low base, right? Prices were pretty resilient last year, and right now they're actually not that far below the record achieved in the post-pandemic period. But what this does show is that at least there's a pickup in transactions, and that was really the problem last year, because how do you price a market that is basically not a market if there are no transactions? So there is a pickup in activity, that's according to the survey. And actually, the chief economist at Rick's, he said on radio earlier that prices have achieved a soft landing, which I think is perhaps a good way of putting it. Also, estate agent Savills, so that's one of the biggest estate agencies in the UK. They're also updating. They also had an update this morning saying that most markets appear to be past the moment of peak uncertainty. So again, from a base of uncertainty, no transactions, people didn't want to sell into a market where you don't know where mortgage rates are going to go, you don't know where interest rates are going to go, and at least now there's a bit of clarity on that. Guys, not convinced.
Let's hope so. Maybe. I think people weren't selling last year because they didn't have anything to buy either, which I think remains a significant risk. And trying to figure out how to unstick the market remains a key challenge for the government. How sensitive is the market to rates, though? What are Rick's telling us about that? You talk about the certainty. If rates come down, does the market take off? Is it as simple as that?
There's a little bit of a lag. So what's interesting about the mortgage market, it's priced off the swaps curve. And actually, a move higher translates far faster into higher mortgage rates than a move lower. So it takes some time for that to show up in the banks, in the rates that banks are offering. We are seeing a little bit of a move, a kind of a race to the bottom among some of Britain's biggest mortgage providers, because there's this competition to really get business, given how bad the year was last year. But now, people are kind of a little bit more convinced that the BOE will cut rates 3 times this year. They're kind of between twice or 3 times. We'll see what the BOE says next week. Nobody's expecting anything changing anytime soon. But again, expectation that at least we're very much past the peak rate, and that interest rates will fall, will help confidence.
Yes, I mean, I suppose that's the risk there, isn't it, Sophia? That this all happened, this slight positivity in the housing market, a return of some transactions. This all happened because of an expectation that rates will be cut. And the longer we have to wait for that expectation to actually be delivered on, the more people and swaps markets might start to ask, where are rates heading and when are rates heading downwards? Because there is such a lot of expectation built into, as you say, the swaps curve.
Yeah, we have already seen, Anna, that kind of reassessment of expectations this year, right? Because in January and at the end of this December, people were expecting 5, almost 6 rate cuts from the BOE. So we're really, really nowhere near where we were at the beginning of this year. But, I don't think it's just that. It's also the sense that the UK is perhaps already out of a recession. We saw the growth figures yesterday, 0.2% growth in January. It's not fantastic growth, it's still very much flat, but the word recession really does scare people. And the fact that maybe, that was just a story of the end of last year and not this year, and perhaps things are brightening in 2024 can help sentiment. Also, guys looking at me, still not convinced that that's the story.
My poker face needs to improve.
It's a neutral
face. My resting skeptical face is kind of the natural starting point.
Now you know what I deal with every single day. Sophia, you were talking about this data point and going into kind of sentiment for housing broadly. How much of this affects the BOE's thinking going into next week? I love what Anna Andrade says over at Bloomberg Economics, which is that the sensitivity over at the BOE to one single data point is so much bigger and magnified in the UK relative to its other peers. What's the read-through here?
And Anna Andrade and her team actually revised their outlook for growth in the first quarter, so no longer seeing a contraction, but now actually seeing growth. It's not just the sensitivity to data points, it's the sensitivity to 0.001%.
Yeah.
It's really kind of a rounding error when we're dealing with such small numbers. For the BOE, the inflation picture is still very much the dominating force. I don't think growth will matter as much, and we saw, there wasn't really a market reaction from the data yesterday, so inflation still very much the story. Obviously, that's also moving in the right direction for the BOE, as are wages. Yep. That's the other data point. But I think the message that will be reiterated next week will still be one of caution and still a tougher job to be fought on the inflation front.
Sophia, thanks very much. Sophia Holter-Acosta from the markets today, blog, keeping track of all the UK news flow for us. You can find that blog on the front page of the Bloomberg UK website, or you can type TLIV Go on the Bloomberg terminal. Yeah, we didn't make much mention of the UK economic data yesterday. It was only 1 month's worth of data, but anything that sort of changes the dynamics slightly from the recession of the fourth quarter, maybe worth noting and moving on from.
It's hilarious that basically we've gone from a recession, doom and gloom, to growth, but the difference in the data is tiny, so minuscule, and almost certainly will be rounded later on.
Chair Powell is somewhere looking at this and cringing, and
I'm cringing.
I'm skeptical, apparently permanently.
Apparently, a lot of emotions on this. One thing we didn't talk about with Sophia was simply kind of the read-through on some of the commodity stories as well, and I feel like the UK isn't really the first place where we look to for that kind of read-through when we look at oil or green transition or any of that. And I kind of feel like Rishi Sunak almost changed the way we even think about the green transition here in the UK.
Caught people by surprise by that, actually, that slight step backwards.
Which I'm curious how that translates into the corporate sphere, though, when you see something like that.
Were people surprised? Like, there's been this kind of mood music shift from the government that it's becoming more sceptical post that. Kind of trying to think where it was, the by-election near Slough somewhere, that basically it was all about what happened in the UK and the low emission zone being expanded, and suddenly the government realised that maybe there was this shifting narrative in terms of the electorate on whether or not we were moving too fast with the green transition.
Yes, a lot of conclusions drawn rightly or wrongly from that particular by-election about what it is that will play well at the ballot boxes. I think some of that pivot last year did catch the government off guard, but now we're seeing a bit more of it. Firstly, the initial policy backstep, and then around gas yesterday.
Yeah.
Well, it's not a secret that going green is expensive at its core.
Yeah.
The UK has a finance problem, obviously. It's why the United States is not leaning into green as easily, because at the end of the day, it's expensive. It's still an inflationary environment. People don't want to touch it from a kind of fiscal point of view. But then we got to explore the corporate side as well. Shell, for example, you're seeing evidence of this already, weakening their target for near-term carbon emission reductions. The oil and gas giant now aiming to cut CO2 by 15 to 20% by 2030. That's compared to the 20% previously pledged. Let's get more on the story. Bloomberg Senior Executive Editor on Energy and Commodities, Will Kennedy, joining us this morning. Will, what's going on? What's going on here?
Well, the new CEO has set a different, broader strategy for Shell to his predecessor. His predecessor was responsible for these targets, while Sawan, the new CEO, is very focused on the core oil and gas business, less focused on investing in new energy businesses. Now, the carbon measure that Shell uses is a measure of carbon intensity, which is a bit of a dry way, but it basically means that new low-carbon businesses would help reduce the overall emissions of the company. Now, with fewer of those businesses, it's going to be harder to meet that target. Yeah. Shell would really stress that the long-term target remains in place, and this is just an adjustment to reflect the changing strategy overall.
Wants a higher multiple, doesn't it?
I mean, this is all about his focus on valuation and catching Exxon and Chevron, which get a much higher rating from investors in the US, and they don't have these same sort of targets. So in a sense, it's all part of the broader picture of his focus on increasing returns to investors, and investors have been quite clear is what they want is cash generation from the oil and gas business and returning that cash to them, and he wants to close the valuation gap he has with Exxon and Chevron.
We're watching oil markets or energy markets more broadly, Will, on another story, and that is around the Ukraine attacks that we've seen on Russian refineries. I think Ukraine's hit a third Russian refinery, an escalating series of drone strikes on Russia and the energy infrastructure there. Are we seeing read across into pricing already? And if not, what are we waiting for?
Not quite yet. I think there's a lot of nervousness in the market. Obviously, Russian crude goes mostly to Asia, but there are parts of the European energy system that still need Russian products, diesel in particular. Fortunately, we're coming out of the winter period where demand for diesel is higher and coming into the summer where it switches to gasoline. But if this continues, and if they were to hit a major export refinery like the one they tried to hit near St. Petersburg and failed earlier this week, it could have ramifications. And also, if it really does impact Russian production of gasoline and diesel, because obviously they don't want to have shortages in Russia, and they've got a big war effort to fuel. If that was to happen, one policy option that Russia might have would be to curb exports of fuel, and that would have ramifications. So it's definitely one to watch. It's definitely making people nervous, although there's no major impact quite yet.
Keep an eye on that one. It's interesting to see US gasoline prices rising already and quite sharply before driving season really gets underway. Political implications of that, I will keep an eye on that story as well. Great to see you, Will. Thanks very much indeed for joining us. Bloomberg Senior Executive Editor on Energy Commodities, Will Kennedy. We're going to have much more on this story. Remember, we've got the IEA report coming out very, very shortly, and we are going to be spending a little bit of time with the IEA, get a little take on what is happening. The IEA's monthly report is going to be coming out, and I think they're going to be dealing with that in the Pulse a little bit later on, which I think is Tom Mackenzie's ship today.
I believe so. I believe Francine is in Rome, but Toriel Bossoni joining us from the IEA. I think that's worth mentioning.
I'm glad you went with that pronunciation. I decided I was not going to.
You have to.
You got to nail it.
I attempted. I attempted.
Well done. Coming up next, Francine Lacroix, talking of the Pulse, will be joined by the former president of Croatia for an exclusive interview from the Bank of America Global Investor Summit. That is taking place in Rome. Looking forward to this. That's next. This is Bloomberg.
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg. Welcome back. This is Markets Today. 45 minutes into a European session that shows modest gains across a number of these markets here in Europe. The US equity session showing some upside, and actually increasingly so. E-minis up by 0.3%. NASDAQ futures up by 0.5%. We will be back with the markets in just a moment. Let's take a pause, though, and focus in on some geopolitical themes this morning. Bank of America is holding its second Global Investor Summit in Rome, with the future of technology, markets, and much more on the agenda. Geopolitics, as I say, a feature there as well. Francine Lacqua joins us there from the event with a guest. Fran, good morning.
Good morning, Anne. I'm delighted to be joined by Kolinda Grabar-Kitarovic, who's the former president of Croatia and has a deep understanding, of course, of some of the geopolitics that especially our region is facing. Thank you so much, former president, to join us today. There's a lot being said, of course, about your future. You're one of the tour de forces in politics, both internationally but also nationally. What do you plan on doing next?
Well, my political future has been subject to much speculation, both in Croatia and abroad. Indeed, yes. I cannot dismiss the potential of running for office sometime in the future. However, I have no immediate plans right now to run for office in Croatia. My focus remains what I love most, and that is international relations, security, and stability of the transatlantic community, especially in these times of war in Europe and geopolitical turbulence beyond Europe's borders.
You were, of course, one of the contenders for a possible NATO Secretary General. Is there anything else that you would like to eye up to make a difference, actually, in these uncertain times?
Well, what I have been doing, focusing on, as I said, on international security and stability, and trying to bring about solutions using also Croatia's experience. Most people forget that we had a war in Europe in the 90s, and then we have a lot of experience in peace negotiations, reconciliation, rebuilding, demining, etc. When it comes to NATO, of course, this is the crucial time. The role of the NATO Secretary General is more critical than ever, and it's important that the right person be selected, the person who will not only understand the current circumstances, but also have the foresight to understand the emerging security challenges, to keep the cohesion within the alliance, but also to project strength outside of the alliance.
What worries you most about NATO if President Trump were to be in the White House?
Well, the U.S. election right now, I would say, is a coin toss. So we don't know who's going to win, and it's really not up to us. It's up to the American people to elect their new president. With President Biden, of course, what we can expect is a continuation of the current situation, so it offers more stability and predictability. with President Trump potentially winning this election, it would be more unpredictability. He has set some statements in this pre-election campaign. However, I do believe when a person comes into office, when they are briefed about the security situation and all the implications, they do modify their views in terms of bringing about security and stability. It is true that on the European side of the transatlantic relationship, there is worry. There is bracing, I would say, both by American allies and American adversaries of what would come next. But again, I do believe also in the strength of the transatlantic alliance, which benefits not just Europe, but the United States as well. And that said, what I have been advocating for years is that we Europeans do have to do more in terms of providing for our own security and defense. After all, defense is a national responsibility. And we need to do more to strengthen our defense industrial base and security overall.
What does that look like? I know President Macron also got in hot water for suggesting that he would send and would ask other European countries to send troops to fight Russia and Ukraine.
I don't think that any NATO member country would want a direct conflict with Russia. But what is important is to diffuse any potential situations that could flare up, that could be also the result of a simple mistake or miscalculation, which actually worries me most. And also to be able to deal with Russia's expansionism. We're in a phase where we're facing the election in Russia, which of course is always a little bit more heightened in terms of tensions and rhetoric. But we also have to make it clear to Russia that we will not allow for that expansionism to continue, that Ukraine has the right to self-defense and to their own choices, and they need to continue to be supported in that, but also that Europe will continue to defend not just our borders, but our people, our resources, and our values.
I mean, again, there were cryptic comments from the Pope. It's unclear. You have a better understanding, maybe, of Vladimir Putin than most. You've had a number of one-on-ones. What is the end game? How do you see this conflict actually going on?
I cannot assume how much has changed since I last saw him, which was in early 2020. However, what I can see right now is that he is rather confident, that he has time to spare, that he's waiting. Definitely Russia is waging a war of attrition, not just on Ukraine, but really on the determination of everyone else who's supporting Ukraine. And we see that Ukraine, yes, has become a distant second on the geopolitical agenda. So the crucial support to Ukraine to be able to defend themselves this year will continue to be a priority number one. I believe that in case that Ukraine should lose this war, this would not be an end to President Putin's ambitions for domination and restoration of Russia's power.
So for the moment, it's extremely difficult to unlock aid, to send money actually to Ukraine from the U.S. Can Europe fill that gap? And again, it could become much more difficult if President Trump were in the White House.
This year, 2024, will be pivotal for the war in Ukraine and defend themselves. Right now, we're in the state of a positional warfare where Russia is making some minor gains that have actually huge psychological impact both in Ukraine and elsewhere. And I see that there is war fatigue developing everywhere, that there is talk about negotiations, but the question is whether Russia is ready for negotiations. And of course, it's up to Ukraine to decide on negotiations when, where, and what about. Because we are talking about a war of self-defense on Ukraine's territory. It's not a war that is being waged in Russia. So Ukrainians need to be able to defend themselves, and I am concerned if they do not have the capabilities, especially for air defenses, that Russia could make more advances, and potentially the war could end with Russia taking over the whole of Ukraine.
All right, thank you so much for joining us. A lot to think about, and of course a lot of the politicians and policymakers to think about. Kolinda Grabar-Kitarovic, the former president of Croatia. With that, I'm going to send it back to you, Kriti in London. We'll have, of course, plenty more from Rome throughout the day.
Francine Lockwood there, with the former Croatian president. We thank you so much. And like she said, we will have plenty more over at the Bank of America's second Global Investor Summit in Rome coming up throughout the day. Some of the interviews are going to be crucial from the likes of Blackstone and, of course, Bank of America on the markets, on the geopolitics. We're going to hit it all.
Interesting that conversation then talking about Putin waging a war of attrition. You wonder if it's a war against the US electoral calendar as well, with politics and political change potentially on the horizon in the United States. Let us tell you what is coming up, though, before that, in terms of the agenda for today at 11 a.m. UK time. NATO's Jens Stoltenberg will be speaking. 12:30 p.m. we get PPI data, retail sales data out of the US. That's got to be the focus for markets in terms of the data releases. We'll also hear from a host of ECB speakers today. Also worth noting, though, Guy, we were mentioning earlier on these lines from the ECB's Yanis Stanaris saying there must be 2 cuts in ECB rates before the summer break. Took us into a rabbit hole of establishing when exactly summer was, but a bond market seems to be shrugging off that type of thinking.
Well, I think he is well recognised as being kind of at the outer extremes. I can't think of anybody that is actually more dovish than him in terms of his commentary recently surrounding the ECB. But the fact that even that conversation exists, that he's trying to maybe shift the centre of gravity, I think is really interesting. Two before the summer.
That's June and one before.
Let's call the summer June.
Yeah, but I think that was the definition that we were helpfully provided with by the French central bank governor yesterday. So I'm going with that.
Let's assume that that's June. So he wants 2 before then.
Yeah.
I'm assuming 50 basis points. Also, the cadence is interesting here. Does the Fed go once and then wait? Maybe the ECB goes kind of 1, 2, 3, 4, maybe 4 we get to. I don't know. It's going to be... But the fact that he's talking about that kind of cadence is interesting as well.
The conversation around the lag seems to be very fuzzy. No one is talking about what the lag looks like anymore. When people said that 12 to 18 months is what it took, but then somehow post-COVID, the lag may not be 12 to 18 months. It might be faster in terms of hikes. And now I'm curious what the point of this kind of, if we do see that cadence of start, stop, what's the point of even doing that? Because a lag is not going from 12 to 18 months to, 30 to 60 days?
On the lags, it very much depends on which central bank, and it very much depends on the structure of the exposure to those rates and where it comes from. We had some really great research from colleagues here at Bloomberg talking about actually how the rate hikes in the UK didn't have the same impact that you might have expected in the beginning because of the way it boosted savings, and that was part of the story.
And people with no mortgages and savings got the biggest, and everybody was on a much more on a 5-year mortgage, say 3-year mortgage, so you didn't get that change coming through. It's interesting though. You look at Powell's pivot in December and the acceleration you saw in January, February in the US economy. Maybe the lags are much shorter than we originally thought they were, because he loosened up financial conditions significantly, and you got that almost immediate response.
Yes, that lag is very short. The financial conditions lag.
It is, and I think that's where the markets really come in handy here, right? Because if you actually look at the way that makeup comes, so much of it in the U.S. is from the stock market. Then you have credit conditions here, which we were talking about with our guests earlier as well, and that's where I think the real estate piece kind of feeds back in. He actually said, Victor actually said that he actually does see that the CRE risk is there. Not huge, but that it is there, which is quite contrary to what we've been hearing.
But quite specific. He was very much ring-fencing that. We're going to watch and see what Apple does later on high. Defense stocks look like they're up this morning. Got Leonardo up on a JP Morgan raise as well. You've seen Rheinmetall tracking a little bit higher as well.
Get an oil report shortly.
Getting that oil report coming through shortly. And it does look like the growth stocks, which were weak yesterday, are back in the groove today. Let's put it that way. Anyway, the Pulse is up next. Some great guests coming up on the Pulse. This is Bloomberg.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, live from Bank of America's Global Investor Summit in Rome. Now, here's what's coming up on today's program. Stocks struggle for momentum as investors eye U.S. factory inflation data due today for fresh clues on the Fed's rate path ahead. Meanwhile, the Greek central bank chief says the ECB must cut rates twice before the summer break. iPhone maker Honhai reports its second straight quarter of strong profit growth as AI demand lifts sales, and the clock is ticking for TikTok. The fate of the popular video app is now in the hands of the U.S. Senate after the House votes to force its Chinese owners to sell up or face a ban. The company tells employees its strategy remains the same. Plus, of course, I've been speaking to a range of big names from Bank of America. There's plenty more to come. Now, at 9:30 UK time, we'll be joined by the bank's chief investment strategist, Michael Hartnett. So let's also take a look at the European markets map. Now, a lot of investors, of course, focus on exactly what's been happening. The one thing that we need to watch out for is some of the inflation data and some of the things that we need to keep an eye on. Now, the thing that I'm mostly watching is that for the moment, if you look at the CAC 40, we're seeing quite a lot of green, but the focus is not only of some of the data coming out of the U.S., but of course, some of the thoughts that the ECB could cut interest rates before anyone else. What does that mean for the future? What does that mean for some of the things that we need to look out for? On the Bank of Greece, Mr. Stornaras recommends 2 rate cuts before the summer. And if you look at the path forward for the Fed, a lot will also depend on what we've seen from oil. Now, oil markets, we're just getting this IEA report. I'm really looking forward to, as always, speaking to Toril Bozzoni of the IEA. They've just come out with their report. Oil markets facing a supply deficit all year on OPEC+ cuts. So let's get more from Toril Bozzoni, the IEA's head of the oil market division. Toril, as always, thank you so much for joining us. A lot of the focus, of course, is on what OPEC Plus will do. Are you assuming that the cuts will continue well into the end of the year?
Good morning. Thank you. What we changed in this month's report, following the decision by the OPEC Plus to extend the cuts through the second quarter, and then the announcement that they would only gradually unwind them once the market conditions warrant, we decided to hold them in place until the group announces or confirms that they will indeed unwind the cut. But based on our own balances, we do show some room for the group to increase production later in the year.
But Toril, did you consult with OPEC Plus? I know it's a little bit unusual. How confident are you that this is kind of the right base case?
Well, so what we do until the OPEC group alliance, as they say, they will meet again in June, and they would then decide, look at the market conditions, see how demand is going, see how non-OPEC supply is going, and what room there is for them to increase their productions. So we are not saying what we think they will do. We're not saying what we think they should do. We're just putting in saying until there is confirmation that they will unwind the cuts, we're just holding them in place in our market, in our base case, to see what that looks like for the market.
So if OPEC Plus doesn't extend into the second half, does your outlook then tip into surplus? And what does the rest of the year look like then for oil demand and consumption?
So the way we're looking at it now, in the third quarter, we have a deficit of about 700,000 barrels a day. So depending on when the allowance does unwind the cuts, by how much, at the pace of it, of course, then we will see we could have a surplus in the second half of the year, but it depends really on the extent, also on oil demand growth and non-OPEC supply. So we will wait and see. Once the market direction becomes clearer, OPEC will look at the market themselves and set the course for production policy for the end of the year.
So your 2024 oil demand, Toril, growth forecast is up some 50% since you introduced it last June. Much of the oil industry, of course, is seeing that. I'm looking at the numbers growing by at least 1.5 million. What does that mean in terms of some of, again, the forecast into the foreseeable future, 2-3 years down the line? I know it's extremely difficult to forecast, but how much of that, I guess, volatile demand comes from China?
So our forecast for oil demand growth this year is about 1.3 million barrels a day. That's down from 2.3 last year. It's true we have increased our forecast for this year over the last few months as the outlook for the global economy has improved, especially for the United States. The economic growth assumptions that feed into the forecast have improved. And the hard landing seems to now be avoided. We also increased the oil demand growth for this year due to increased demand from shipping industry, the closures or the diversions of ships around the Red Sea due to the unrest there and continued tanker attacks around the Cape of Good Hope is adding to demand from tankers. We also seeing that the tankers are increasing the speed to make up for the lost time. So this is one of the reasons why we have boosted oil demand growth this year. We are seeing a slowdown compared to last year and the year before in the data. In mid-2023, we had oil demand growth of more than 3 million barrels a day. That slowed to less than 2 in the fourth quarter, now 1.7 in the first quarter of this year. And we're seeing as the recovery from the pandemic is running out of steam, economic outlook is weaker this year than it was in 2023. And efficiency improvements, electric vehicles, we do expect a steady deceleration in growth, but still growth in oil demand for the remainder of the year.
Yeah. Toril, when will you see normalization in energy flows through the Red Sea?
It's difficult to say. We're seeing continued attacks. Even last week, we're seeing tankers being hit by missiles, and increasing numbers of tanker owners are diverting their ships around Africa for insurance reasons, for safety reasons. So it really depends on stability in the region. We do not see a big shift back through the Suez Canal and the Red Sea until the security situation improves.
Mm-hmm. So given your forecast for deficits, actually this year, why do you think oil prices have been pretty much stuck so far in 2024? And are we still going to see moderate prices from now until the end of the year?
It's a very good question. What we've seen, so we're seeing prices trending gradually upwards. Inventories on land are at the low level. For 7 months, they've been declining. And this is also in part due to all the oil that is piling up on water, as we say, due to the diversions around the Red Sea. So we are seeing oil prices ticking upwards. If we're indeed seeing oil inventories continuing to decline in the coming months, if supply is not sufficient to meet demand, we do expect some increased upward pressures on prices, but it depends. There's many factors at play. All the oil on water, almost the highest since the height of the COVID pandemic. Once that comes on shore, we could see a little easing, but it depends on the extent of the deficits that we will see moving forward.
Tara Bozzoni, as always, thank you so much for joining us. That was the IEA's head of the oil market division. Now, Bloomberg has also learned, talking about oil, that Saudi Aramco is in talks to add top Wall Street banks for a secondary share sale in oil giant Aramco. Now, the kingdom reportedly plans to hire JP Morgan as one of the main underwriters to the offering. Bank of America and Morgan Stanley are also contending for lead roles on the deal, which could raise as much as $20 billion. Now, coming up, stocks muted as investors eye U.S. factory inflation data due today for fresh clues on the Fed's rate path ahead. We'll bring you analysis next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it. Traders looking ahead to factory inflation data from the U.S. later today, with retail sale numbers and initial jobless claims also due. Now we're joined by Grace Peters, Managing Director and Global Head of Investment Strategy from JP Morgan Private Bank. Grace, as always, thank you so much for joining us. Now, we've had multiple highs on various indices. Are you still moderately pro-risk, or is now the time maybe to take stock? And good morning.
Good morning to you. So no, we came into this year pro-risk, positive specifically on equities, and we've actually just upgraded our price target for the S&P, European stocks, as well as Japanese equities, because the underlying data continues to be pretty resilient. When we look at the state of the consumer, when we look, say, at net household wealth in the US, it's making new all-time highs in itself, $156 trillion. And obviously, you've got positive real wage growth also helping the consumer. So we think the combination of that resilient macro backdrop, but also with the corporate story being so strong about balance sheets, the ability to invest, to spend capex in key themes like artificial intelligence and security needs means that there's still a good story to be had in equity markets.
So, Grace, what's the bull case, which you've kind of laid out, but if the S&P goes higher from here, again, what supports it fundamentally, and by how much can it still rise?
I think the most realistic bull case to me is that corporate profits are stronger. When we think about our base case expectations to get us to 5,300 on the S&P, we're looking for 8 to 9% earnings growth in 2024 and 2025, and a large part of that is technology, artificial intelligence, prop creating across various sectors. To get to a bull case, I think there's two ways to do that. As I say, the most realistic to me is that corporate profits come in stronger, that there's more operating leverage in the system, and therefore you could get earnings growth that exceeds current expectations and that gets you to around 5,600 on the S&P. The other way to get to a bull case would be stronger disinflation, which would mean more rate cuts than the market's pricing that would support a higher multiple on equity indices. I do think that the stronger profit scenario is the more credible, given what I said just a moment ago about the strength of the consumer and corporates at large. But 5,600 would be what we're aiming for if you want to push for a more blue sky scenario.
Grace, there are many questions about Europe and whether now is the time actually to go longer on some of the European equities because we're seeing a rebound and things seem to be looking up. Of course, some say that this is going to be still a very difficult period for Europe because of the price of oil, because of what's happening in Ukraine. Are you more invested in Europe than you were 2 months ago?
So Europe, I think, is a very interesting market. I think you do have to be more specific. And so what are we looking for companies in Europe that we invest in? It's companies that are very much aligned to these global themes. Europe specifically has very strong exposure to premiumization in luxury goods and across other sectors, including autos, where the global household wealth picture can feed directly into the European corporate. So I think that's one theme that for us is evergreen in Europe and still absolutely stands today. But when we're thinking about technological-driven themes, AI, semiconductors, Europe has a handful of companies. And also when we're thinking about industrials, some really strong industrial companies in Europe that very much feed into data center growth, supply chain reorientation, and automation at large. So I think there's a lot to like in Europe. We tend to stick with the larger companies. So if you're thinking about at the index level, it would be the Euro Stoxx 50 rather than the Euro Stoxx 600. But I think that even before we think about the European economy itself, there's much to like in European stocks. And then there is the possibility as well that the European economy is starting to bottom out. The PMIs have positively inflected, GDP, we think the same. And therefore, even the story for European domestic businesses and the banks are in a much stronger position than they were if we go back to the decade post the Great Financial Crisis. There's lots to go for, actually, in European companies as well.
But Grace, is this because they've been undervalued for such a long time? Or is this also because there's Capital Markets Union, there's a number of directives, regulation put in place that could make M&A more attractive and therefore bring prices up?
So I definitely think the strength of the balance sheet that feeds into both the M&A and also the shareholder return story is key. When you look at the share buyback yield on European equities, we're pushing close to 2%. And of course, post the Great Financial Crisis, Europe was very much a net issuer of equity. So I think there's been a fundamental change in the landscape for European balance sheets, which makes for an attractive investment proposition. I'd also say European businesses and their exposure to these global themes are very interesting. And of course, Francine, valuation as well. When you're looking at Europe, on around 13.5 times forward earnings compared to the US, closer to 19 times. If you've got businesses that can generate growth but trade at a discount, that is something that is increasingly attractive, particularly in a slightly higher inflation world where you need to be able to out-earn that cost of capital.
Japan is, of course, in obsession with everything that's going on with possible monetary policy, trying to unwind this great experiment of the last 15 years. Do you see value and opportunities in Japan equities?
Yeah, so I think the theme that unites Japan with Europe and also views that we have on the US market is back to that balance sheet argument. And what we've seen in Japan is that cash has been trapped on balance sheets for a number of years, but because of various initiatives, actually some of that cash is starting to come back to shareholders. And that could be a multi-year story. So that combination of a little bit of reflation, corporate activity, returning money to shareholders, and a market that isn't quite as cheap as Europe on face value, if we're using a price earnings basis, but still looks attractively valued when you adjust for that cash. I think Japan is also an interesting market. And all of that's to say, Francine, that when we talk about equities making new highs, that was part of our December outlook, that is beyond just the S&P, and we've had, I think, 16 all-time highs in the S&P so far this year, but that doesn't mean that investors shouldn't look beyond the US, and I say particularly thinking globally about themes like balance sheet strength and buybacks, artificial intelligence, and national security needs, security of supply, that I think is structurally changed post the pandemic, leads to lots of fruitful ideas.
Grace, very quickly, just to round us off, there's mixed signals, certainly in gold, and for example, what Bitcoin's been doing this week. How do you look at the market mood and the kind of appetite that there is out there? Does it bring opportunities for investors to I guess, be counter-cyclical or to change a little bit of where the money is going? Where does the smart money go?
So I think that this is indicative of the fact that there has been cash held on the sideline that is waiting to get invested. And I think as well, when we think about some of the more concept stocks, we would actually rather not chase unprofitable businesses. They've generally lagged so far in the rally. And so we know across the market, it's tempting to say, well, what hasn't moved up that I should now chase, given that markets have pressed ahead? I think what I've mentioned so far is that we are quite inclined to stick generally with the winners so far. But if I were to look for a market that's lagged that we think is interesting, it would be mid-cap companies, particularly in the US, where you've still got a market that hasn't yet returned to previous highs and a valuation story as well, particularly earnings growth coming through next year.
Grace, thank you so much. As always, Grace Peters, their Managing Director and Global Head of Investment Strategy at JP Morgan Private Bank. Now, coming up, the fate of TikTok is now in the hands of the U.S. Senate. We'll have plenty more on that next, and this is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do.
that brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Now, the U.S. House of Representatives has passed a bill to ban TikTok unless its Chinese owner sells a video sharing app. Now, its critics have accused the platform of being a national security threat, while TikTok CEO has called the decision disappointing in a video he posted on the site. Now, let's go straight to Bloomberg's Alex Webb now. Alex, 170 million Americans use TikTok. What's next for the bill? What does this mean for TikTok?
So the next thing is it obviously has to somehow get through the Senate, and that looks like a far bigger challenge. It obviously passed through the House with a massive majority. There are still concerns about this in a number of different guises. There are concerns about whether it's infringing upon free speech. That's on both sides of the aisle. Republicans, just for free speech purposes. Some people in the Democratic Party, such as Alexandria Ocasio-Cortez, she thinks that it's a place where really young people can express themselves. At the same time, there are ways that politicians themselves communicate with young voters. This is a vector for that. So there are lots of reasons why it might have more difficulty getting through the Senate. It does, of course, still have its supporters there. What does it mean for TikTok? If it does somehow get through, it's more likely to be a divestment than it just shuts down completely. We know there are plenty of buyers out there.
Okay, Alex, thank you so much. Alex Webb, of course, we'll have plenty more from Alex throughout the day. Of course, this plays also into the geopolitics between the U.S. and China. Now, coming up, after the world's largest assembler of iPhones posted a 33% jump in profits, we look at how Hanhai is becoming more of an attractive bet for AI. So we'll have a full roundup of Hanhai profits. We'll also have a look at exactly what we're expecting from the Fed going forward. We'll speak to Monica Defend of Amundi and also then the Chief Investment Officer of Bank of America. We're here at their Capital Markets Forum in Rome. This is Bloomberg.
Was around so many powerful people my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time, surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Stocks struggle for momentum as investors eye U.S. factory inflation data due today for fresh clues on the Fed's rate path ahead. Meanwhile, the Greek central bank chief says the ECB must cut rates twice before the summer break. iPhone maker Honhai reports its second straight quarter of strong profit growth as AI demand lifts sales. Plus, the International Energy Agency says global oil markets face a supply deficit throughout the year instead of the surplus previously expected as OPEC Plus looks set to continue output cuts. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, as always, but today we're in Rome for the Bank of America conference. Now, this is a picture across the board for U.S. futures. Again, we do have some data. The obsession with what the Fed does in inflation continues. U.S. future, for the moment, seeing a little bit of a lift-off. S&P futures 0.3% higher. NASDAQ 0.4% higher. Of course, on tech, the big story is 140 million users of TikTok. It's now in the hands, its fate is in the hands of a Senate. I think about 100 senators will decide whether they really need to sell or not. So we had a great roundup from Alex Webb on the fate of TikTok. Let's now talk to the iPhone maker Honhai. It's reported a second straight quarter of strong profit growth after lucrative AI hardware sales helped really offset this weakness in demand for smartphones. And Taiwanese company is the world's largest assembler of Apple's iPhones. So let's go straight to Taipei to Bloomberg's Jane Lee. Jane, great to speak to you. So how do these results actually show how AI is driving that growth for Honhai?
Well, the strong profit growth, it was up 33% on year for the fourth quarter. That's a little bit, it's not completely clear because there was a giant one-off profit there, but a one-off profit line. But what we did see was a huge excitement during the earnings call about AI and where this company's AI future is going. The stock has risen about 15% just in the last week after some excitement that maybe, it's not been put at the forefront as it should be with the AI story. And the chairman during the call said that already in 2023, about 30% of its server revenue came from AI servers. Now, it's not completely clear what that means. Does that also include equipment that goes along with this, but that could be used for, more traditional servers? Is this extra special cooling equipment? That's not certain. But what is certain is there's a lot of excitement around AI for Foxconn.
So, Jane, I guess the outlook, I was going to ask you about the outlook specifically for AI server business for Foxconn and the wider Asia market, but does it also point to a weakness in Apple demand in China, and how much does that expand?
Right. That is the sort of the negative story in this whole thing. Earlier this week or earlier last week, Counterpoint, a data firm, came out with numbers showing that the iPhone sales in China in the first 6 weeks were down nearly a quarter. And so that's gotten a lot of people worried. And that will definitely take, some edge off the growth going forward, because it does make up more than half of Foxconn or Huanhai's business. But the company is very clear that it wants to grow the AI business, and it's aiming for 40% of the AI server market. Going forward, it's expecting to have some announcements next week at NVIDIA's GTC conference. That NVIDIA is the chip company that is at the center of the, the AI buzz here today, because it makes all the chips that train all of the OpenAI AI models and other models as well. So investors will probably be looking forward to what those announcements might be, and we'll all have to watch the stock to see if it moves any further up.
We will. Yeah, we will. Jane, thank you so much. Jane Lee there in Taiwan. Now, for a good conversation of interest rates, also after we heard from the ECB Governor Yanis Tornaras saying that the bank, the ECB, must reduce rates twice before its August summer break and make another 2 cuts before the end of the year. Now, the Greek central banker also said the ECB should not be swayed by the Fed. Let's bring in the head of the Amundi Institute, Monica Defend. Monica, as always, thank you so much for joining us in Rome. It's a tough gig sometimes coming to Rome, where it's sunny, to talk about central banks and the inflation path forward ahead. I mean, there's so much concern that the ECB goes first. Does it actually make a difference for markets and to you whether the ECB cuts before the Fed?
Honestly, it doesn't. After the pandemic, we think that really the central banks have been to focus on their own business, on their own region issues. Therefore, I subscribe what the governor said on cutting twice before the summer. This is what is in our part. Then we have 125 basis points towards year-end, meaning that the situation, the economic situation in Europe seems to be less resilient than the US, and the focus has to be on inflation on both sides.
I mean, the US seems more than resilient. If you look at all the measures, right, productivity, everything seems to be going the right way. Are you concerned that actually there's troubles brewing, that consumption maybe is not as strong as expected, especially in kind of the lower income earners?
Well, we do expect a slowdown in the U.S. economy kicking in the third quarter. So it is not a technical recession anymore, but there will be a slowdown. There is a change into the narrative and probably the balance sheet. The balance sheets on the public sector, on the private sector, on the corporate sector are into play. And this can alter a little bit the dynamic that we have been seeing so far.
What is the market's misunderstanding the most? I know we spent around 18 months, first of all, getting the call on the U.S. wrong, but also there's been this mismatch between what central bankers were telling us and investors and what the markets were pricing in.
Well, on inflation, there was a mistake out of the central banks, and broadly speaking, there has been a change in the framework, and the way the dynamics of the economy are evolving. Excess savings, they were not there before. Front-loading the investment on the corporate sector in the United States out of the IRA, it was not there before. And again, the real estate played quite a role in the balance sheet of the households. While on the inflation, I would say that probably looking at some micro evidence, it was probably easier for us to get the change in the pattern and in the regime of inflation on the way up and now on the way down.
Do you worry about 2025 again? We're in a big election year. Throughout the board, 4.5 billion people, I think, are going to the polls. That's almost, more than half almost of the world population. Is that going to be inflationary because people that are in charge don't want to lose the election? And then is there a worry that actually we don't really know what happens in 2025?
Our story is the one of inflation retracing progressively lower. It won't be linear. What is at stake with elections is, as you were saying, that there might be a change in the policy framework. We see probably it's too late, but the market is not really at the moment pricing in the outcome of an election.
Why?
Because it's impossible to price in, because the risks are too high, especially on geopolitics?
No, I think that really there is still this obsession on inflation and on macro uncertainty. So it's probably a near-term thing. Going into the summer, I think the focus might change. Once the central banks will be formally pivoting, then the attention will probably focus on the outcome of the elections.
Monica, how much time do you spend looking at, for example, Japan? I mean, there's a couple of idiosyncratic stories, or the UK, where it's the general sense that actually we got away despite COVID, despite some of the concerns out there, and that now the path forward globally is towards growth.
We spend a lot of time, meaning with this macro uncertainty pending, it is really difficult to find top-down stories that play out. So it's time for idiosyncratic story. And Japan has been quite a surprise, I would say. It was last year probably the corporate reform. Still, it is something that is at play. But there is an interesting inflows into the equity market because of the changing in the investors' appetite. I'm referring to the savings plan. So this is going to have a role. The yen, the central bank, still, it is something where Japan is out of sample, let's say this way. And in the UK, yes, probably this is again where the Bank of England might surprise, anticipating a bit depending on the mix between growth and inflation.
I mean, they have a hard job, but again, it's also an election year, so I feel like it could change the dynamics.
It can, but still the central banks so far are leading the rope. So probably they are not the only game in town anymore, but still they are leading the rope.
Monica, as always, thank you so much for joining us. That was the head of the Amundi Institute, Monica Defend. Now, coming up, we talk more central banks. We'll have an exclusive conversation with Michael Hartnett, Bank of America's chief investment strategist. That interview is up next, live from the Lenders Global Investor Summit in Rome. And this is Bloomberg. You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
You're looking live at the Principal Room. Coming up on Bloomberg Surveillance, an interview with Hapag-Lloyd Chief Executive Rolf Haben Jansen. That's at 7:45 a.m. Eastern, and this is Bloomberg.
I do try to think through what happens when Japan really does settle into positive rates. There will be winners and losers, and corporate balance sheets and bank balance sheets, and the cost of the Japanese Treasury funding its own debt will be a question. But I think it'll be a new paradigm which we haven't seen for a while. I think that'll be interesting.
Well, that was Bank of America's International President, Bernie Mensah, speaking to me a little bit earlier on the anticipation around the Japanese economy and Treasury policies. Now, U.S. equities scaled record highs this year, driven by the frenzy around AI and optimism about a pivot from the Fed. The gains have knocked analyst year-end stock forecasts out of the park, leaving them scrambling to catch up. Well, joining us now to discuss this and much more, I'm pleased to welcome Michael Hartnett. He's Bank of America's Chief Investment Strategist. Michael, as always, thank you for joining Bloomberg.
Pleasure, Francine. Thanks
Where's
for having
the
me.
biggest mismatch? Where do you see the biggest buck for your money?
Well, if there's a bubble, which it certainly sort of feels that's where the momentum is moving to, often in bubbles, you find that a barbell strategy works best. You obviously want to own what the bubble is, but the bubble will drag something in its wake. Right. So, for example, if you look in 1999, the only market that outperformed the NASDAQ was Russia. I mean, who'd have thought, right? But it did because it started the year on 3 times earnings and ended on 6 or 7. So what distressed asset is going to go up? With AI and all this sort of stuff, and it probably is going to be something like distressed tech or regional banks or even China.
But Michael, so first of all, there is a bubble, right? Are you seeing a bubble?
There's characteristics of a bubble. Right. It would make sense.
In what? The Magnificent Seven?
Yes. And AI-related stocks, and you can see a little bit of it in crypto as well. I mean, there's tremendous euphoria. The euphoria is there because of the Fed. The Fed wants to cut rates. Come what may, and the markets are front-running that in gold, in crypto, in equities, even in corporate bonds. But a bubble, is when too much money chases too few goods, and everyone wants chips, and there's a lot of money sort of chasing that. And yeah, I think it has characteristics in terms of price, the speed of the movement, the valuation, the breadth. Bubbles are narrow, bull markets are broad, and this isn't very broad.
A bubble could take like 3-4 years to burst.
It doesn't necessarily have to pop right now.
But do you think it pops right now? Or soonish?
Well, first of all, we're going to find out a little bit in the next couple of months, because there's no doubt that the macro data in the US is becoming a little bit more ominous, particularly the labor market. There's no doubt that the labor market is cracking in the US. At the same time, there's a human being in America that thinks inflation's going to 2%, because it's not. It's stuck between sort of 3 and 4%. So that backdrop of inflation coming in a little higher than expected and growth coming in a little weaker than expected, that's normally not good for risk assets. But if risk assets say, we don't care, we've got AI and all this sort of stuff, that is very symptomatic of the sort of bubble mentality.
But at some point, again, when do they start carrying? And there's also concerns about a treasury auction going wrong because of the level of debt that for the moment everyone's ignoring. The $1 trillion question.
It's a $1 trillion question. The debt is going up $1 trillion every 100 days. I mean, it's just amazing, right? So yes, I mean, there's always that risk. There's always going to be risks abounding, but normally markets care because central banks make them care. It's either that the central bank says we need to pop that, or if the central bank hasn't got the backbone to pop it, real interest rates go up. Real interest rates in the US 10-year about 2%. I think if you got to 2.5, 3, you'd really be challenging and putting a lot of pressure on the more speculative parts of the asset markets at this moment.
Do you worry about liquidity in the markets?
No, not now. No, I don't think so. I mean, I think, again, the debt story is more important because I think that bond yields can go up from here. Again, look.
To what kind of
levels? I think if you don't get a recession and you have this debt and you have this spending and you have, 2 candidates in the election, neither of which are particularly interested in balancing the budget, you could certainly move towards 5% without a question. But if, what no one expects now, there is a recession, there is a hard landing, the labor market may be sort of telling you, actually is coming. You know, obviously that's not going to happen. That's the thing that makes bonds outperform.
How do you see the U.S. economy performing? Because there are also questions about, you know, the bottom 25% of earners and their spending power. Can the top keep on sustaining this momentum?
Well, part of the story, I mean, it's twofold, isn't it? It's fiscal and the labour market. The fiscal story just continues to be off the charts. I think just in the past 5 months, you know, we're here in Rome. Rome, I think, has a GDP of about $300 billion, you know, dollars. The American government has spent $350 billion on military equipment just in the past 5 months. I mean, the spending is, you know, just very, very strong and is stimulatory. But the labour market, I think, is cracking. And I do worry a little bit that, again, everyone's expectation for a warm, cuddly, soft landing. The labour market is the thing that can take a soft landing and make it a hard landing very, very quickly if that cracks.
So what does that mean for the Fed?
The Fed would have to cut. I mean, obviously, if unemployment was rising, if you move in unemployment towards 4.5%, the Fed would have to cut. The Fed would cut aggressively. Is that positive for the markets? Much less so. I mean, right now, the Fed, you know, the market's rallying, the Fed's going to cut, and there'll be a soft landing. If the Fed's cutting because unemployment's rising and the payroll's falling, that's much more negative for asset prices, without question.
All right, hold that thought, because I have many more questions, Michael, but we do need to take a break. Michael Hartnett, Bank of America's Chief Investment Strategist, staying with us, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Welcome back, everyone. Still with us, Michael Hartnett. He is Bank of America's Chief Investment Strategist. Michael, thank you for sticking around. We're having a good conversation about some of the weirdness in the markets. Yeah. We're talking about gold going up, Bitcoin at a record. What does that tell you about where the market's head is at?
I think that's representative of a feeling that the Fed is losing credibility, that the Fed seems very determined to cut interest rates before it reaches its 2% inflation target. We know inflation just in the last month or two has started re-accelerating. And so I think if the Fed is really saying, we've got to cut, we've got this window of opportunity in the first half of the year, we've got to take it just in case, I think that makes people nervous about the Fed's credibility. It also makes people nervous about the dollar. And you know, if you're looking for hedges against the dollar and hedges against, you know, further debt problems in the US, crypto and gold fit that bill. And I think part of their attraction is really that.
How do you model the US election, depending on who wins?
Well, it's going to be tight. You know, I think we know that. I think in the first half of the year, the market sort of look at the election in the US, there's elections in other important places as well, like India, as a positive. I think they think that at the margin, it makes monetary, fiscal, certainly energy policy likely to be easier than it would otherwise have been if it wasn't an election year. So I think part of the zeitgeist right now is that the elections are bullish because it means a little bit more stimulus. I think in the second half, certainly the US election, I think if it's Trump winning, all other things being equal, the market sort of thinks lower yields, lower dollar. I think if it's Biden winning, it means higher yields, higher dollar. Because you think about the conclusion of who wins. You know, Biden wins with high inflation but low unemployment. He's just going to say, well, high inflation doesn't matter. All I got to do is keep unemployment low, spend. Whereas if Trump wins, he's going to say, well, I won because inflation was too high. I've got to get it lower. So I think who wins and the conclusions they draw is going to be quite important as to how the market sort of trades that.
But does Donald Trump, for example, tear up the Inflation Reduction Act? And does it?
Well, I don't know that that's his plan. I mean, I think he's got certainly differences with regard to Biden and with regard to taxes and various other things. But you know, the bottom line, if you think about it, they're both. You know, neither of them are kind of going to run on, I'm going to balance the budget, and you know, both of them are going to run in terms of like, we're going to be tough on China and generally have American first policy. So I think, again, it adds to this story that the 2020s is just going to be a decade where the cost of capital and inflation is higher than it has been the past 20 years.
Michael, very quickly, what do you do with China right now?
Well, I think China looks quite attractive, to be honest with you. And they're kind of ironically in a US election year, because I think that most of the bad news is into the Chinese market. I think it's starting to perform a little better. My favorite way of playing it is a little bit like the other markets have been played, where you buy, you know, the best companies. And we've seen that in Europe, we've seen that in the US. You know, and there are lots of good companies.
So TikTok is, you know, could be about to be sold off.
Yes, I mean, there's always these idiosyncratic risks, and I get again the case against China. But again, I think that if, again, as I was saying earlier, things will be lifted up by the general euphoria, and I think China seems one of those good candidates.
Michael, thank you so much. Michael Hartnett, there, Bank of America's Chief Investment Strategist. Now, that's it from Rome for now, but surveillance is up ahead, and this is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The balance between growth and inflation plays out.
The economy is on a cooling path, but it's a very gradual path. There have been a lot of tailwinds for the economy.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market on the S&P 500 positive by 1/3 in yesterday's session, pulling back from all-time highs just a touch. A fairly quiet state of affairs over the last 24 hours. That picks up in about 2 hours and 30 minutes time. Get a ton of economic data, retail sales, PPI, Lisa, jobless claims just around the corner.
It's the last inflation read before next week's Fed meeting, and to me, this is the key point. Do we get a confirmation of what we saw from CPI? And if so, do markets care? Because so far, it hasn't seemed like anyone's been particularly fussed about the fact that inflation keeps coming in hot, and the Fed is still going to cut rates. That's the belief right now.
That disinflationary spell, if we can call it that, over the last 6 months feels a little dazed and confused at the moment. Citi's Andrew Hollenhorst, and we talked about this note yesterday, he called it the last mile problem. How big is that last mile problem?
Well, it remains to be seen, but PPI will give us a little bit more hints of what's going on. Also, retail sales. What is going on with the consumer? I look back into the reports that happened in January, the earnings report. Walmart's CFO, they're being choiceful. They say consumers are still coming into the store. They're shopping frequently, but they're trying to be choiceful on what they're buying. Is that going to see a softer retail sales? Is that going to maybe potentially put a little bit of a dent of this resilience we've seen in the American consumer?
Well, speaking of what's going on with the consumer, look at the estimate for jobless claims. If jobless claims is anything to go by, nothing's going on with the US consumer. The US consumer is totally fine. 218 is the estimate for jobless claims today. Last week, 217.
Yeah, the whole thing about it's noisy and there aren't enough people reporting to the surveys doesn't really work because it's this way every single week. So then it raises this question,
what do we have to reassess in terms of where we are? Jenny Yellen yesterday was talking about how she actually was wrong with respect to what the rate was post-pandemic, that she does think that it's going to be higher. And that, to me, really indicates that people are reassessing what this means and how hot this economy really could run.
You took us down to Washington to talk about Secretary Yellen. Let's talk about what happened through the House. TikTok bill breezes through the House. Then senators start to line up just to say, slow down. We take our time here in the Senate. This could drag on and on and on.
It absolutely can. And then you look at some of these hawks, usually on foreign policy, like Lindsey Graham. He was on Fox last night, and he said, well, it's a good question when he was asked about how he's going to vote. And he said, I'm leaning yes, but his concern is, and he's kind of coming in line where the former president is, so potentially that's why he feels this way. He's concerned about if TikTok's not there, where do those individuals go? And it's the Facebook Meta play. It's the potential of Google, X, Twitter. But the bottom line is, and I was pretty astonished to see yesterday the bipartisan support, one, for it passing, but also the bipartisan support of the no's. Marjorie Taylor Greene lining up with Alexandria Ocasio-Cortez. It's not every day you see this in Washington.
Well, but isn't that the way it always works, that the polls kind of come together? And that's sort of where we're at right now. I am curious about this pushback because of the political affiliation of the potential buyer. The fact that you want a conservative buyer to come in and take over TikTok's operations. Are we going to have hearings to sort of, justify someone's credibility on one side of the aisle or the other before they can take over this, because you want to prevent it from the liberal social media companies of Meta taking over? I mean, really, where is this going?
I found the whole episode very entertaining, particularly hearing what China's got to say about the whole thing.
That was hilarious.
The reaction from the counterfeit capital of the world. This quote right here: when someone sees a good thing another person has and tries to take it for themselves, this is entirely the logic of a bandit. Can I share with you a report that came from Catherine Tai in the last year or so? WeChat, China's most popular chat app, one of the largest platforms for counterfeit goods. Counterfeit and pirated goods from China, together with transshipped goods from China to Hong Kong, accounted for 75% of the value of counterfeit and pirated goods seized by US Customs and Border Protection. So to hear China talk about bandits and stealing other people's things when the stats sort of say something else about what happens in the mainland is rather entertaining.
It's also pretty rich that they're saying the U.S. should respect the market economy and principle of fair competition. To that point, let's think about this for a second. That's all I can say.
Well, also, what American social media company is actually being able to be successful in China? None of them. So it's just a little bit funny. Also, the TikTok version in China, very different on how they allow children to engage on that platform than it is in the United States.
We're on that story in just a moment. Let's start with the price action this morning. Busy day ahead with tons of economic data. Equity futures on the S&P 500 firmer here by 1/3%. In the bond market, yields a little bit lower this morning at the front end, down about a basis point, but at least they're creeping higher. We've gone from the 440s to the 460s on a 2-year yield in quite a short space of time.
And we're slowly pushing back expectations for a June rate cut. I mean, basically, that's where we're at right now. It's down to 73% from 78% the day before yesterday. How much do we see this continue? Because at a certain point, don't we have to have some sort of capitulation to this idea that maybe rate cuts aren't going to be as great as people previously thought?
That could be dependent on stronger economic data. We might get that later. I was also looking at the ECB, another speaker over at the ECB. This time, I think it was the Greek central bank governor talking up 2 cuts before the summer break. Keep looking at the calendar now. Summer break starts in August for the ECB. 100 basis points maybe this year. That's when you start to think about maybe what's the difference between the ECB and the Federal Reserve for the year ahead.
And what does spring and what does summer, what do they mean? Because that might be what they come down to.
Is that what they're going to do in the news conference with President Lagarde at the next meeting?
Summer? Why do we have to talk about this? More on that later. But honestly, it's fascinating to see the divide, given the fact that the peripheral regions don't need it as much as Germany, and Germany is still the hawk versus some of the others. So kind of twisted state of affairs.
Euro dollar right now, 109.40. Coming up this hour, Russ Kostrick of BlackRock as mega cap tech pulls the S&P 500 down from all-time highs. Tobin Marcus of Wolf Research as a bill to force the sale of TikTok heads to the Senate. And Julia Coronado of Macro Policy Perspectives ahead of PPI and retail sales due at 8:30 Eastern Time. We'll begin with our top story. Mega cap tech pulling the S&P 500 down from all-time highs as traders await PPI and retail sales data later this morning. Russ Kostrick of BlackRock staying optimistic. We remain constructive on the macro backdrop. The Fed's first cut will come in June, and we continue to like growth, including software, healthcare, and select consumer names. The constructive Russ Kostrick joins us now for more. Russ, can I get into the month of June? it feels a little stale, Russ. I keep hearing June, and I'm wondering what informs that based on the information we've had in the first couple of months of this year. What informs your view?
So good morning, Jonathan. You know, I'd start by saying something else maybe, which is that, is this necessarily the most important thing that's going to happen to the market this year? So I think June's a reasonable baseline. You know, our view is the Fed's still likely to cut 3 times this year. We had that view coming into 2024. The market started the year differently. But at the end of the day, you know, as you mentioned a few moments ago, the market has been remarkably resilient as we've repriced from 7 cuts down to 3, as we've gone from March to June. And I'd say that whether the Fed goes 4, 3, or 2 is maybe not as important as the fact that long-term yields have been relatively contained. The economy is still solid. We're likely to get 2.5% real growth, 4.5% to 5% nominal growth. That's a good background for earnings. And this is why I think the market has continued to move forward, even as investors have repriced these Fed cuts.
Has the market gotten a little over its skis, though, Russ? And I talk about this with the credit spreads on high-yield bonds now at the lowest going back to the beginning of 2022. You've got equal weight outperforming as this rally does broaden out in the equity market. It all began because the Fed was going to start cutting rates. Now they might not cut rates as quickly, and it keeps on going. Is it really justified?
Well, at least I think that's a fair question. I mean, look, stocks have definitely had a big run. I don't think it would shock anyone if we had it, you know, some point in the not too distant future, 5-6% pullback. I do think there's an important difference between 2 or 3 cuts and no cuts. And this is maybe one of the risks that investors do have to be aware of for the market, which is that you can live with slightly less easing by the Fed if it's happening in the context of a strong economy and strong earnings. Now, if we get to a point where inflation is so sticky that the Fed goes the entire year and doesn't cut, yes, I agree that's qualitatively different, and that's something that probably leads us to a different conclusion than if you get 2, 3, or 4, it's probably not as big of a driver as all the other things that have been supporting stocks, including a lot of money coming into the market, a lot of cash, a lot of dry powder still on the sidelines.
Russ, the other thing that I'm struck by is you said that one of the reasons why people have gotten this enthusiasm is because of stability in long-term rates. We saw that again with yesterday's auction of 30-year notes. Pretty successful, strong. And yet we keep talking about how the leverage has been shifted to the U.S. government and how at some point this is going to be a problem and you're going to see it reflected in structurally higher yields. Why doesn't that give you any concern?
Well, I think it is a concern, but again, I think it depends on the time frame you're looking at. I was speaking with clients yesterday. You know, look, if you're talking about the deficit, I do think this is a real issue. It is structural, as everyone knows. It's not obvious this is going to derail the market in 24. Does it come up in 25, 26, 27? Hard to predict. But again, in the short term, I think the market's going to focus on what is the volatility of rates, what's happening with the Fed cuts to a degree, and the strength of the economy. And as you were talking about a moment ago, the labor market remains remarkably strong. Initial jobless claims remain low. You know, we generally have an environment where earnings are coming in pretty strong. That's more likely to drive the market over the next 2 to 3 quarters, in my opinion, than the federal deficit.
Russ, you have been underweight long-end U.S. duration, though, and if that's not on supply, what's it on?
Well, it is mostly supply. And I think this is where you do start to have some concern about the effect of the deficit, both short and long term. And again, it doesn't mean that you're necessarily going back to 5%, but you've got $2.5 trillion of gross supply you've got to sell. You've got an environment where many of the foreign buyers are, you know, less engaged. The Fed is still shrinking their balance sheet. And the term premium, in other words, you know, the incremental return you're getting for going out on the curve is still relatively small. So when we look across the different asset classes, in our opinion, there are better places to be. We've remained modestly underweight, with most of that underweight on the long end of the U.S. curve.
Russ, you're killing me in the space of 60 seconds. It doesn't matter. It kind of matters. We'll move on. We'll talk about equity markets. Let's talk about your overweight to equities and corporate credit, a bias to U.S. equities, a little bit of Japan as well in the mix. Russ, I want to talk about that little bit of Japan. Seen a big move in the Nikkei year to date on the Nikkei 225. Started to see it pull back after the yen started to strengthen. Russ, what's the relationship between the two?
You know, the yen makes a difference, but again, I think it also affects what part of the market you're thinking of. So Japan is ripped. We still think there's upside. You know, I think people are now well aware of the reasons. normalization of monetary policy, corporate reform. What I would add to that is, as we spoke about in the beginning, the market globally is run. Japan is still probably the place in the world we still see the best value. Having said all that, I do think we're at a point in the cycle in Japan where you start to shift the exposure a bit. So, for example, banks have had a great run. Are they going to lead the market going forward? Maybe not. Some of the domestic plays, which actually benefit from a strengthening yen. So we still think this market is upside, but you maybe start to think about where are you in this market relative to where you might have been 3 or 6 months ago.
Russ, just how crowded is that trade in your mind, from your perspective at the moment, given how excited people seem to be about it in the last few months?
When I look at across all of the world, I don't think it's the most crowded. And as you say, it's been a huge run, but let's put it in perspective. You just took out the high, which was established in 1989. And this was a market, I can tell you from talking to institutional investors, individual investors, that no one owned for a very long time. They forgot about it. So yes, people have come back into Japan in the last year, but it was very owned for a very, very long time.
Took a while to get back there, Russ. It's good to see you. Russ Kostrick there.
Thanks, John.
Of BlackRock. Appreciate it. It's underweight the long end of the US Treasury curve. Supply kind of matters just a little bit on the equity market. Let's talk about Japan. Have you seen shares of Toyota over the last 12 months? Just compare the chart to the chart of Tesla, the difference between the two. We're going to talk about the automakers a little bit later. That's not just because it has a Japanese ticker, by the way. That's about Toyota committed to hybrids and not making the move to go into the pure EV play like we've seen from other manufacturers. And they've benefited massively from doing so.
I'd be interested if someone breaks out how much is because it's a Japanese company and how much it's because they're embracing the hybrid. But they are getting it right. It does highlight how Japan is now suddenly this new engine of growth that it hasn't been for so many decades. And it sort of exemplifies why people are going on in beyond just sort of a currency trade that may or may not continue to be a positive one.
Yeah, it's still a question, isn't it? You drop from 150 to 140, 30, 20. Where does that leave stocks?
Well, maybe we won't ever find that out because former Bank of Japan officials coming out and saying probably April is the time, so cool it, and I wonder how much you'll get a weakening in the yen if that happens.
147.82 on dollar yen, unchanged on the session. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Treasury Secretary Janet Yellen says it's, quote, unlikely that market interest rates will return to pre-pandemic levels. The yield on the 10-year U.S. Treasury notes averaged 2.39% in the decade through 2019. But last October, it spiked above 5% after the Fed raised rates aggressively to combat inflation. It now sits just below 4.2%. Saudi Arabia is pushing ahead with one of the largest stock offerings in recent years. The kingdom is said to be in talks to add top Wall Street banks for a secondary sale of shares in oil giant Aramco. Sources say Saudi Arabia plans to hire J.P. Morgan as one of the main underwriters to the offering. Bank of America and Morgan Stanley are also contending for lead roles on the deal, which could raise as much as $20 billion. Rents in Manhattan rising during a busy February for leasing. The median rent for new leases in February came in at just over $4,200, up 3.3% from a year ago. Overall, the number of new Manhattan leases signed in February were up nearly 8% from last year. Rents typically drop during the winter months, but apartment prices haven't let up. That's your Bloomberg Brief. John?
Big month in Manhattan. Yara, thank you. I won't talk about that a little bit later.
Yeah, you don't want to think about it.
Up next on the program, TikTok's fate resting in the hands of the Senate.
We have invested to keep your data safe, and our platform free from outside manipulation. We'll continue to do all we can, including exercising our legal rights, to protect this amazing platform.
That conversation coming up next, live from New York City this morning. Good morning.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
Stocks on the S&P 500 positive here by 1/3% on the S&P after pulling back from all-time highs in yesterday's session. Unchanged on a 10-year, 419.38. Yields creeping higher over the first 3 days of this week. Under surveillance this morning, TikTok's fate resting in the hands of the Senate.
Just wanted to share some thoughts with our US users about the disappointing vote in the House of Representatives. We have invested to keep your data safe and our platform free from outside manipulation. We have committed that we will continue to do so. We will continue to do all we can, including exercising our legal rights, to protect this amazing platform that we have built with you.
Here's the latest this morning. A fight over TikTok heads to the Senate after the House overwhelmingly passed a bill to ban the app or force the sale from its Chinese parent company. The next stop is likely the Senate Commerce Committee. Chair Maria Canwell saying she's very concerned about Americans' data, but stopping short of committing to taking up the House bill. Tobin Marcus of Wolf Research joins us now. He does not think anything happens before November. Tobin, can we talk about that? You've got 5 reasons to why it won't happen. What are they?
Yeah, thanks, Jonathan. So first, the Senate has a long history of killing House bills. This would not be the only thing that's passed the House in huge bipartisan numbers in the past few months that the Senate's just sitting on. Number two, I think we're already seeing key senators show a distinct lack of enthusiasm about picking this right up and move with it. You mentioned Cantwell. You know, she has a kind of competing approach. I think she and other senators are going to chafe at the idea that because the House suddenly sprung into action on this particular bill, they need to follow the House's lead. That's not really the way the Senate operates. Number three, the congressional calendar is a complete mess. This needs some kind of a vehicle to ride along, because I think it's very unlikely it gets a standalone Senate vote. There are not a lot of those vehicles going around, and the closer we get to the election, the more things we're going to shut down and move into campaign mode. Number four, Trump's flip-flop on this, I think, obviously complicates the politics on the Republican side, but less discussed is what it means on the Democratic side. You know, I think heading into a campaign, there's going to be reluctance from Democrats to do this in a way that lets Trump say, you know, I stood against this and didn't want to take away this service that people like. You know, there's sort of an implicit bargain that the blame on this needs to be spread around, and Trump has somewhat thrown that out the window in the past week. And then finally, there are some First Amendment concerns. I think at a minimum, there's uncertainty about how litigation would go based on what we're seeing in the proceedings around the Montana state ban. And that's going to be a concern for some senators also. So, you know, the picture changes the farther out you get, but between now and November, it's hard to see exactly how and when this moves forward.
Given that reluctance, is that why Majority Leader Chuck Schumer put out one of the most vanilla, lukewarm statements I've ever seen come out of the Senate? He's saying the Senate will review the legislation when it comes over from the House. This passed overwhelmingly with bipartisan support, and Schumer's basically like, meh, maybe we'll get to it.
Yeah, I mean, when the House says jump, the Senate doesn't say how high. They say maybe sometime eventually if we feel like it. It's, you know, they have their own bills. I mean, you know, you've seen some of the Senate leaders on this issue get in line. So Mark Warner did come out and say, let's move ahead with this particular bill. But in general, there's a lot of turfiness between the House and Senate. There's sort of no love lost between the chambers, even when they're looking at their co-partisans on the other side of the Capitol. And, you know, it's not surprising at all that Schumer is responding in this, you know, as you say, essentially empty way that leaves all his options open based on how conversations go.
TikTok, though, is still under CFIUS review. So if Congress doesn't act, what happens to that review?
Yeah, I mean, that's a great question. We're now on, what, year, you know, 3, 4 of that. I think the general understanding has been that the administration is apprehensive about moving forward with their, I think, fairly open preference to compel or sort of influence the divestiture based on concerns about how it would go in court if they attempt to order that. I think the kind of paper trail going back to 2020 under the Trump administration about the sort of considerations here and whether or not you can mount a sort of plausible national security case that's free of politics is a concern. But everyone I talk to, both inside and outside of the administration, has a distinct lack of confidence in their ability to prevail in court if they were to move forward there. So, it seems to me like that probably stays in limbo too. They obviously don't want to sign off on the Project Texas mitigation plan that the TikTok folks would move forward, but they also, I think, understandably are not eager to take their chances in court.
And the idea of divestiture becomes even more complicated when you have all the arguments over who is an acceptable person to buy said TikTok, right? I mean, how realistic is it that there would be any kind of agreement on which company would be viable, which company has the funding, and what the government's role is in facilitating that?
Right. I mean, I think the biggest obstacle is from Beijing's side. They have said openly that they're not interested in approving a divestiture, sort of at the point of a gun from the U.S. side. And of course, that's been the message from ByteDance. Also, you're playing the video before. They're going to exhaust all their legal options. They're sort of going to fight this to the end of the day before going along with this. The logistics around sort of figuring out who has the financial capacity to absorb this, who would actually make sense as a buyer, sort of how you manage the antitrust concerns. Those are all very real also, particularly on the short timeline that's specified by this bill. But, I think the biggest obstacle is probably from the Chinese Communist Party in terms of willingness to approve it.
That's an interesting point. I want to finish on the former president as well, Tobin. We've talked about this over the last few days. Complete 180 from him from where he was about 3-4 years ago on this issue. And we're trying to figure out what that could mean for US-China relationships under Trump Volume 2. What does that look like, Tobin?
Yeah, absolutely. I think that there's a prevailing expectation that U.S.-China tensions just get sort of uniformly worse under Trump. Obviously, he has this proposal for a 60% tariff on all U.S. imports from China, which would be quite a drastic escalation of the trade war. But I think we saw in the first Trump administration, and we're seeing again now, that there is a great deal of transactionalism. And so sort of if you're willing to flatter him, both from a U.S. side, from Xi's side, there's the possibility, I think, for kind of selective easing on various different points. Like in the early days of COVID, he was quite complimentary of Xi and the Chinese Communist Party's COVID containment strategy, based on the fact they were trying to kind of close the phase 1 trade deal at the time, including a big sale of U.S. soybeans. So, the Chinese are using this as a propaganda tool, not least in Taiwan. There's a pretty open effort to try and tell the Taiwanese, if your story of how you continue asserting independence from the mainland is by relying on the U.S., Trump is not the guy who's going to be there for you, because you sort of can't count on him to stay strong on these various kind of hawkish positions if political winds change.
Tobin, really thoughtful stuff. Appreciate it, sir. Tobin Marcus there of Wolf Research. I just want to pick up on a couple of points. The one point is, I think we're all sitting here assuming that ByteDance would actually sell it. And we're going through a list of US companies that have the money, it's a long list, and a list of US companies that might get the green light from Washington, much shorter list. Also got to consider the fact that maybe they won't allow it to be sold.
Which is what he thinks is the more likely potential vehicle, and what this could do to the tit for tat in terms of the messaging domestically in China.
Much more on TikTok throughout this morning. Coming up next, Bloomberg's Craig Trudell on troubles facing Tesla and the EV market. That stock is down again this morning. We're negative 1.4%.
top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Cap tech towards where? The Russell, small caps. That's where the options market was leaning into with an upside bias and has been for a while.
It has been for a while, looking for that shock upward move. If you take a look, for example, since the middle of February, the Russell 2000 has still underperformed, even as the equal weight outperforms, even as you see small caps, or rather the large caps not necessarily outperforming. Russell just still hasn't gotten off the mat.
The Russell this morning up by 0.2%. Under surveillance today, US retail sales PPI data due out at 8:30 Eastern Time. Traders waiting to see if the inflation report will confirm or deny this week's hotter than anticipated CPI data. Bloomberg Economics expecting PPI likely rose 0.4% month over month from 0.3% prior. Investors will also be looking for a possible rebound in retail sales after weather and seasonal adjustments weighed on the figures from January. Retail sales PPI, jobless claims, take your pick. What are you focused on?
I mean, PPI is going to be interesting because it is the last inflation read before the Fed's meeting next week. And it does go into the PCE core reading that the Fed likes to look at. So put that aside for a second. Curious to see if you do get a hotter than expected PPI report, does the market finally react the way that we think that it ought to, given what a lot of people were saying before CPI?
Well, the way they set up for CPI and how they reacted after maybe means PPI will be, to your point, a little bit of the same. I'm interested in retail sales. We talked about what Walmart CFO had to say in January. The Walgreens CEO, similar. Retail customers in the U.S. are under stress and making deliberate choices to seek value. So does this resilience continue, or do we start to see a little bit more cracks? Is it going to be seasonal, or is it actually going to be softer?
Data drops in about 2 hours' time. Let's get the Janet Yellen view of the world. The Treasury Secretary, Janet Yellen, warning we may be in a new normal for interest rates. Speaking to reporters on Wednesday, Yellen saying, quote, "I think it reflects the current market realities and the forecasts we're seeing in the private sector. It seems unlikely that yields are going to go back to being as low as they were before the pandemic." Yellen's comments come during a trip to tout Biden's economic policies, including the Inflation Reduction Act. Treasury Secretary Janet Yellen hardly with a controversial take on the bond market at the moment.
Well, here's the thing, though. She's shifted her language. January 2023, she said they were more likely to come down, in line with where they were before the pandemic. January 2024, she said the jury's still out. And now she says it's unlikely.
What did she say to Fox Business yesterday?
Well, to Fox Business, she said she regretted saying inflation was transitory, but then she did explain that I think for most people, when they think transitory, they think days and months, not in years, and potentially maybe it's how you define transitory is the issue.
That was the apology.
Yeah, that was the apology. She has said she regretted it before. To be honest, though, from my reporting, it was Janet Yellen that was the one behind the scenes saying, we should be a little bit careful on inflation. It might not be as quick as you are expecting. But she also said the trend in inflation is favorable, but it might not be smooth. That's exactly what the Fed's dealing with.
Let's think about things that aren't smooth, and that's getting deals done in Washington, D.C. at the moment. So President Biden expected to voice new concerns over the proposed deal from Japan's Nippon Steel to buy U.S. Steel. Shares of the Pittsburgh-based company falling by the most in nearly 4 years. Nippon is offering to buy the company for $55 a share in cash. In a joint statement, the company saying the deal will strengthen U.S. jobs and national security. The comments coming as Biden hits the campaign trail in Rust Belt states like Wisconsin and Michigan later on today. Look, if you think it's difficult at the moment between the likes of ByteDance and Congress in Washington, Japan's an ally. Japan is an ally, and we think there's national security concerns around this.
Well, this is, to me, the issue. You're doing this right before, the representative from Japan is going to come and to really join the White House. It's kind of an embarrassment, as some people are saying, to basically double down on this. And it also raises this question, do you put your campaigning to try to become the most union-friendly president out there ahead of an international relationship that's key to potential national security?
100% right, Lisa. This is going to be one of the most awkward state dinners because the statement will come before the prime minister heads to Washington. But this is an election issue. Trump said he would ban it outright. In February, the union said they received, quote, personal assurances that Biden has our backs. Look at Pennsylvania. Trump won Pennsylvania in 2016. Biden won it in 2020. This is an election issue. I don't think this is a national security issue.
Look out for a statement a little bit later, potentially. Let's move on to Tesla. The slump continuing, hit by a downgrade from Wells Fargo, calling it a growth company with no growth. Shares closing at a 10-month low yesterday while losing nearly a third of its market cap to start the year. In more struggles for EVs, startup Fisker is plunging after a report from the Wall Street Journal warned the company is preparing for possible bankruptcy. Bloomberg's Trade Trudeau joins us now for more. Craig, we got yesterday a downgrade to Tesla from Wells Fargo. We'll catch up with Wells Fargo a little bit later. We've got an upgrade on traditional automakers in the US from Morgan Stanley. Where's this market going, Craig? Where is it right now?
Yeah, I think to add to that, just this morning we have UBS out with lowering their price target on Tesla to 165. I think they were 225 beforehand. So I think what we're seeing with Tesla is just a very clear, indication on the part of their IR team, kind of canvassing the analysts to say, look, you guys need to take your numbers down, and really setting expectations much lower for the first quarter of the year when we look at what's happening in the U.S. and in China, with a real slowdown in momentum for EVs, and with Tesla, saying to start the year, look, we're going to have a notably lower growth rate. I think this is a case of, we haven't necessarily seen consensus come down to sort of, respond to that. And so we're seeing, delivery expectations dialed back to a significant degree, price targets and recommendations being adjusted as a result of that. And Morgan Stanley, coming out and really sort of, questioning whether or not it made sense to spend as much on EVs, which I think, is a little bit late, to be honest. I think we've already seen the likes of GM and Ford and others, really dial back their investment in EVs, and even, in Volkswagen's case over here in Germany, altogether cancel a plant in Wolfsburg.
Yeah, the South Side catching up big time with this move that we're seeing in Tesla's stock. Craig, it's not just lower growth, it's no growth. I was going through the estimates coming from Wells Fargo. No growth this year, negative volume growth next year. I've got no idea what kind of multiple you should put on a name with no growth when it has such a growthy multiple. Greg, then I look at other names like Toyota. Fact of the matter is the auto sector's doing decently. It's just the pure EVs aren't doing well at all. It's the hybrids. Craig, I remember you and I talked about GM maybe entertaining the idea of leaning into hybrids. Is that where the market is right now? And who's to say it's going to stay there for the next 12, 18, 24 months?
I mean, it absolutely is where the U.S. consumer is. And I think we're seeing acknowledgments even in Detroit of this idea of, you know what, maybe we need to rethink hybrids. And I think Keith Naughton in Business Week just a few months back had a great, in-depth story about the fact that Ford, which, just a year and a half ago was really, sort of beating their chest about, bringing out the F-150 Lightning, the amount of investment that they were putting into EVs. Jim Farley really sort of talking about this being the way forward and sort of setting its sights on Tesla. I think, Farley is a former Toyota executive, led Lexus for a time. I think they've really sort of, rethought their plans, and you're seeing, a hybrid F-150 offering. You're seeing Toyota not being able to keep up with demand for models like the Prius and, the hybrid RAV4. I think we're absolutely going to see some challenges with, some pushback on the part of the consumer in the U.S. And, even over here in Europe, I think, Toyota sort of sneakily, under the radar has really built a heck of a business, building and selling hybrids when, 10, 15 years ago, the Germans wanted us all to go the direction of diesel. And we all know how that ended up. So I think Toyota has not gotten the credit that it probably deserves, questioning just how ready the consumer was to go fully electric. And this is, a palatable solution to bring emissions down from where they would otherwise be, while not necessarily where the regulators would like the industry to get to.
Greg, I wonder if we can write the chapter on electric vehicle subsidies, the idea of some of the discounts that people got for buying EVs in the United States. Was that a failure?
I think it's been a really complicated issue in the U.S. in that, in order to bring those back or sort of give them a new lease on life, Joe Manchin insisted that he needed an American supply chain for batteries and for EVs to be made in America. And that's all well and good. It's of course, very much in keeping with the Biden administration's agenda. But the huge complicating factor in that is we don't have a battery supply chain in the U.S. We don't have, mines and processing and capabilities to bring, cheap EVs to market the way that China does. And so if we're going to push the industry to do that, it's going to take some time, and it's also, really going to, go through some growing pains, because it's going to be more expensive than it is in China for quite a while before we even, sort of start to close that gap. And if we're not willing to sort of put up with the challenge that's going to be, then it is going to ultimately end up in failure.
So to breathe some new life potentially into the EV market, the U.S. would essentially have to say, not all of those goods need to be produced in America or allies, and actually welcome some of the supply chain components from China.
I think there's absolutely some pushing on the part of some members of the industry to say, look, we need some relaxation on these rules. On the other hand, you have parts of the supply chain that say, look, we need the support of the industry and to sort of move forward with this plan to sort of wean ourselves off of China, or else our projects that we're trying to get going in response to the IRA are just not going to survive. They're not going to be viable. And there's a real sort of tension within the industry and within some of the players that aren't necessarily typically working with automakers and their suppliers of exactly how quick do we need to move in order to make this all work. And I think a real sort of you can also tell some hesitancy on the part of folks in Washington, where essentially every time that the Treasury Department has had to make a decision about how quick they move with some of these rules and when are they going to formally implement some of these requirements, they've pushed things back. We've seen so much can kicking, and I think that's something we're going to continue to see.
This started in the UK. Big reality check, just pushing back the timeline. Craig, great to catch up. Craig Trudell of Bloomberg out of London this morning. My favorite graphic right now is just the 1 year move that we've seen in Toyota versus Tesla. This is hybrids versus EVs right here. Toyota is up by more than 90%. Tesla is down by 7 over the last 12 months. It's much worse year to date. They've lost about a third of their value. And a quote from Adam Jonas of Morgan Stanley jumps out to me. I saw this yesterday. EVs may be the future. They're struggling to be the present. Hybrid sales are growing 5x faster than EVs in the United States. That is where the market is right now.
And that's where the hopes and dreams have been shattered when you take a look at Tesla down that much, and down so much from its peak that was reached, I believe, in 2021. We have seen peak hopes and dreams for electric vehicles, and now we're starting to build on what the present is in terms of what people want to buy.
Big time. That conversation is going to continue a little bit later. Just a programming note for you. We'll be speaking with Colin Langan of Wells Fargo on Tesla at 8:45 Eastern Time, after calling the EV maker a growth company with no growth. That story coming up just a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. A bill aimed at forcing a sale of TikTok is moving forward on Capitol Hill. The House passed the TikTok divestment bill by a vote of 352 to 65. It now heads to the Senate, where its prospects are less clear. Majority Leader Chuck Schumer has only said he'll review the bill, and members, including Republican Rand Paul, have come out against it. While investors await the highly anticipated Reddit IPO, the social media company is giving guidance on its expectations. Bloomberg News has learned Reddit is telling potential investors it expects revenue in 2024 to grow by more than 20% versus the previous year. According to its filing with the SEC in 2023, the company saw revenue come in at just over $800 million. Donald Trump is starting to think about what his cabinet would look like if he's reelected in November. Bloomberg is reporting the former president is said to be considering billionaire John Paulson as his Treasury Secretary. Other potential names in the mix for the post include former U.S. Trade Representative Robert Lighthizer and billionaire Jeff Yass. That's your Bloomberg Brief. John?
Yahara, thank you. You know how this is going to go. It's going to be like casting for a Hollywood movie. It's going to go for months. The rumor mill is going to be overdrive. He's going to do some speeches and just throw out random names. This is going to go on forever.
Well, that's what happened with John Paulson. He spoke after the New Hampshire primary saying that guy makes money anywhere, everywhere he goes. Even though he was making money in Nevada, he can make money anywhere. Maybe he'll be my Treasury Secretary.
Maybe the VP. Who knows? Up next on this program, the Fed's elusive inflation target.
The market got way ahead of the Fed earlier this year when the market was pricing in 6 to 7 rate cuts. The Fed wants to be sure that they're actually going to be successful in getting inflation all the way down to 2%. And the not so good inflation prints that we saw recently, just reinforce that.
That story up next. Big morning for economic data just around the corner. This is Bloomberg.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Stocks rallying by 1/3 on the S&P 500, a little bit of a lift. Yields going nowhere. 10-year just short of 420, 419.19. Euro slightly weaker, 109.38 against the US dollar. Under surveillance this morning, the Fed's elusive inflation target.
The market got way ahead of the Fed earlier this year when the market was pricing in 6 to 7 rate cuts. The Fed wants to be sure that they're actually be successful in getting inflation all the way down to 2%. And the not so good inflation prints that we saw recently, just reinforce that. So I think the world is sort of going the way the Federal Reserve was expecting rather than the way markets were expecting. And I think I think there's plenty of time to see how the balance between growth and inflation plays out.
Here's the latest this morning. The Fed expected to keep rates on hold at their next meeting next week after 2 hot CPI prints to start the year. Julia Coronado of Macro Policy Perspectives writing this: we expect the Fed to hold rates steady in a unanimous decision at the meeting next week. Our base case is that the Fed will indicate they are in a holding pattern for now with minimal changes to the policy statement and their baseline outlook, including the expectation that 3 rate cuts will be appropriate this year. I'm pleased to say we can catch up with Julia now. Julia, I want to talk about the difference at the moment between what we see in CPI and what you expect to see in PCE. The chairman was looking for a little bit more confidence. I wonder from your perspective whether he might have lost some.
That is the question. And certainly after the January reading, what we were hearing from Fed officials was it was sort of an anticipated bump on the road. So as Bill Dudley was just saying, the market had gotten ahead of the Fed. The Fed had built in bumps on the road in their baseline outlook. That was why they had a more patient path for rate cutting than the market earlier this year. The question is whether February has rattled that confidence. February was only a little bit better than January, another bump on the road perhaps. We're going to be watching whether the Fed raises its forecast for core PCE inflation for year end and whether it reduces the number of cuts in its baseline from 3 to 2. It doesn't sound like they need to do that right now. They can 3 rate cuts, they could start in June, July, and they'll have more data in hand by then. They are not in a rush, and I think that's the holding pattern idea. They haven't gained more confidence. They haven't necessarily lost confidence. This is sort of an expected bump, but they will have more data ahead, and they can take their time and gather that data.
You say this is an expected bump. Is there anything about the recent data that surprised you, that's made you kind of rethink a couple of your baseline assumptions?
That's a great question. I would say, the January data, we had that worrisome jump in housing inflation. That then reversed in February. So actually that was a bit reassuring. We were very much on alert after the January reading. But there's still the open question as to when that housing inflation takes another step down. It stepped down last year. All the leading indicators say it should cool further. It really hasn't yet. It's been kind of flatlining for about 6 months or so. So that's one thing that, we think that we are going in the right direction there, but we really need the data to confirm that, and the timing and the magnitude are highly uncertain. So that raised a question about when exactly we are going to see that break down to a new range in housing inflation.
Have you rethought, Julia, the longer-term rate expectations? And I'm talking as Janet Yellen brings up the fact that probably we're not going back down to pre-pandemic levels on rates. Do you feel like the recent data has confirmed that this is a new dynamic in the economy that will leave rates higher and inflation higher for a longer period of time?
Yeah, I mean, certainly I think that rates are probably going to land at a higher level this cycle. I think that doesn't necessarily have to come with higher inflation. I think the Fed can get down to its 2% target, but I think the economy has a better productivity trend this cycle. We're not deleveraging like after the GFC. There's a lot of indications, business formations, the labor market resiliency, the investment strength that we've seen from businesses, that we could be on a better productivity trend, and that would mean a higher neutral rate for the U.S. economy. So that isn't necessarily where we are right now. I don't think 5.5% is the new neutral, but it could be 3 to 3.5%. That seems perfectly reasonable.
Julia, you're fantastic at this, so help us out. When we get PPI a little bit later on this morning, what are the pieces of PPI that you're more focused on than others?
Okay, so there's a few key pieces. The overall and the core PPI don't necessarily mean anything for us. What we're looking for is airfares, some components of financial services, some components of medical care. Those are directly taken from the PPI and go into the PCE. So we will get a much better handle on whether PCE is going to be better than CPI or worse than CPI after we get the data this morning. And that, what we saw in the December press conference when Chair Powell acknowledged that they updated their forecasts after the PPI on Fed Day. The Fed's watching this data just as closely as we are. So it's going to be important to see those details.
That's the clinic we needed. Julia, thank you. It's good to see you, as always. Julia Coronado there of Macro Policy Perspectives. Just got a headline from the president. We were talking about U.S. Steel. Here's the headline right now. U.S. Steel should remain domestically owned and operated. Anne-Marie, your take on this one?
Well, that's what I said before. This is an election issue, and this is about shoring up union votes we cannot stress how critical Pennsylvania is for both of these men. Trump won it in 2016, Biden won it in 2020. And this just says to me that election issues of the unions and American jobs is coming before a key ally. This is not China. This is not Russia. This is not Iran. This is Japan.
This conversation will continue. Coming up next in the next hour, Mark Lashini of Jenny Montgomery Scott, Brian Weiser of Madison & Wall, Mark Lifschultz of Blue Owl Capital, and Rolf Haben Janssen of Hapag-Lloyd. That conversation coming up shortly. The second hour of Bloomberg Surveillance up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Just looking at your portfolio of businesses, it is about resilience. It's about pressure. It's about women. How does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We have continued to see equity markets continue moving upward.
Companies are doing well. Earnings are positive. We're out of the earnings recession of last year. Fundamentals are good.
Earnings came in very strong. I think that's going to be what is propelling stocks higher going forward is the fundamentals.
Households and businesses are still in very good shape from a balance sheet perspective.
We are kind of approaching that better equilibrium in the corporate earnings cycle.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market's positive by 1/3 on the S&P 500. The Fed is in a quiet period. We've had very little data in the last 24 hours, so the market narrative driven by the price action of the last 5 minutes or so. That changes this morning at about 90 minutes' time. PPI, retail sales, jobless claims, coming right up.
Okay, so does it matter? Is it going to change the narrative at all? Because frankly, CPI was supposed to be the most important risk-on or risk-off event of the week. It actually did have some interesting nuggets, and it was treated as a dud in the market. So honestly, when will this market take signal from the data that's being dismissed as only one data point, even though we're data dependent?
Would you prefer to talk about a single name instead?
Yes.
Because we can do that. US Steel is down by a little more than 5% at the pre-market. This stock got absolutely hammered in yesterday's session. This from the President of the United States this morning. US Steel should remain domestically owned, Anne-Marie, and operated.
Yeah, we were waiting for this statement. We thought actually it was going to come, according to the FT first reporting that, going to come in a few weeks, but the White House must have felt a tremendous amount of pressure after this leaked. Biden, first off, this has been under CFIUS review as well for national security concerns, but Biden had already pledged, according to the unions, that, quote, he had their backs. He is really choosing the election, the politics of this, union workers, over if there's any potential national security. The bigger issue is this is an ally. And to Lisa's point earlier, how awkward is it going to be when Prime Minister of Japan comes for a state dinner and they decided to block, looks like they're going to block this deal, or clearly putting their thumb on the scale here.
Here's the statement from the president. It's important that we maintain strong American steel companies powered by American steel workers. I told our steel workers I have their backs, and I meant it. U.S. Steel has been an iconic American steel company for more than a century, and it is vital for it to remain an American steel company that is domestically owned and operated. It is 2024, it is election year, and it is not business as usual in America in any way, shape, or form?
National security is doing a lot of heavy lifting. It's doing heavy lifting on every front. We're talking about potential national security for this U.S. steel deal. We're talking about national security when it comes to vehicle manufacturers and what we import or export. We're talking about national security with social media. Will this be the sort of catch-all phrase when someone doesn't like something and wants to have an opinion on it? Oh, national security concern. And what is the risk that true national security concerns get muddied by a sort of political usage of that kind of phrase?
Nailed it. US Steel this morning, TikTok yesterday, Chinese EVs a few weeks ago. Let's talk about EVs. When are we going to find out the final call on what's going to happen with EVs coming from China?
Well, that's something else that the Commerce Secretary is looking into, and also Treasury, I imagine. The president said that potentially we can see more of a tariff on these EVs, but the tariff now is north of 25%. It's 27.5% for China EV coming in. So no one's really going to be buying a Chinese EV with that kind of tariff. The issue is, though, what happens is potential backdoor. BYD is looking into Mexico. Can these BYD vehicles made in Mexico end up making their way to the United States?
US Steel down by almost 5% this morning in the pre-market. Yesterday, absolutely hammered. US Steel was down by almost 13%. The broader market's doing okay. Away from this, equity futures are up on the S&P 500 by a third of 1%. Stocks are higher, bouncing back from yesterday's losses after pulling back just a touch from all-time highs. In the bond market, yields going nowhere on a 10-year, 4.1860. Going somewhere Monday, Tuesday, Wednesday, though, Lisa, and that somewhere was higher at the front end of the curve.
But in a controlled way. And this is the sort of fascinating point. Tick by tick, people are pushing out their expectations for Fed rate cuts. And you could see yields just ticking up marginally, but the auctions haven't been terrible. Yesterday was actually good. You've seen sort of this rush of money into bonds despite some of the longer term concerns, which raises this question, what narrative should we follow next? Because honestly, at this point, nothing is being consistent and working.
The 2-year, 462.39. You're not frustrated about this at all, are you?
This is a frustrating market. It is. I think that there is a sense, I asked one person, how has it been? They said, it's really boring. And I said, what are you doing? And they said, we just have to resist trying to trade because we're bored. And there is this feeling out there where it's sort of finger in the wind. When do we actually get something definitive?
I'm guessing that person wasn't bullish, because if they were, they would have said, it's really chill. It's like boring when it's not going well, but it's pretty chill when things are going well, right? I'm guessing they were pretty bearish?
Actually, they weren't. It's just that it's a boring trade to continue with because it's been the same one and there's not a lot of nuance to it. So all of the creative ideas of how things were going to percolate out aren't really working.
They're not entertained by AI and GLP-1s.
Sure, but if it works, then it keeps on working,
Coming up on the program, more on AI and GLP-1s. We catch up with Mark Lashini of Jenny Montgomery Scott on why tech is, quote, ripe to cool off. Brian Weiser of Madison and Wall on what the TikTok bill means for US social media companies. And Rolf Haben-Jensen of Hapag-Lloyd on the, quote, volatile and challenging outlook for shipping companies. We begin with our top story. Big tech pulling the S&P 500 away from all-time highs ahead of more US inflation data. Mark Lashini of Jenny Montgomery Scott saying it's time to look elsewhere, writing this. While we continue to favor many of the mega tech and tech-related companies, longer term, they are overbought and ripe to cool off. Developments in industrials, materials, and energy are encouraging and present newer opportunities. Mark, I'm pleased to say, joins us now. Mark, let's get into those newer opportunities. What is it that you like about energy right now?
Well, I think a couple of things, and good morning. I think part of it is getting kind of caught up in this cyclical trade that has migrated out of some of these tech names and helped to prop up some of those cyclical areas that you had just talked about that I forwarded you in my notes. I mean, industrials and materials in particular over the last month, but energy is among them. And of course, we know that OPEC Plus has been somewhat stringent with regard to their supply, and we've not seen the kind of diminution in demand we otherwise might have expected coming into this year, particularly from some of the big oil-consuming countries, including the U.S., but also China and India and others. And as a consequence of that, OPEC is still projecting that we're likely to see 1.5% to 2% demand growth year over year. And again, with the constraints on supply, even though we're seeing some oil being pumped out of Libya and Nigeria above levels that was expected otherwise, it seems to be enough to put a bid into oil prices. And with the dollar having weakened here higher by about 2.5% to 3% over the last month or so. That's also helping to be supportive of oil prices. So net with a decent economy here domestically and some improvement we're starting to see emerging globally, to me, that is the ingredient for why oil prices are being propped up and could even continue to grind higher. And so obviously a profitable scenario for an energy patch that has been a laggard over the last 12 months or so.
Echoing that, the IEA out early this morning basically saying because of those OPEC plus cuts, the market faces a supply deficit all year, not just the next few months, but all year 2024. Mark, we've been raising the question, though, why hasn't crude rallied more? We're at 80 just about on WTI, reclaimed that very recently. Brent crude at close to 85 at 84.68. For this to work for you, do you need crude prices here, or do you need them to keep rallying?
I don't think it needs to go up significantly higher. I mean, it's actually somewhat surprising, perhaps, over the past 4 or 5 months, actually. Obviously on the back of the breakout of the war in the Middle East and concerns around Iran's proxies contribution to that exercise taking place that could have ramifications in the Strait of Hormuz or the Suez Canal, and obviously higher prices to ship oil to avoid those areas that are, sort of white hot with regard to the turmoil taking place over there, that there isn't more of a geopolitical risk premium that's been bid in. And I think it's interesting that investors have tended to look through that, or at least assume that it's fairly localized at this juncture and isn't likely to cause an unwarranted spike. But I think nonetheless, at $80 plus for West Texas or more for Brent, that's still exceedingly profitable for these energy companies that are becoming very disciplined with regard to their capital allocations and made technological advances that have lowered their break-even rates such that they don't have to see significantly higher oil prices for them to be exceedingly profitable. And as a consequence, even though they've had some tough comps coming off of 2022 throughout 2023's earnings season, earnings are expected to improve markedly over the next 12 months.
When we broaden out here, there's a pretty big implication in the trades that you like. It's energy, it's also materials, industrials. It's the stuff that really underperformed in the past year or so as we sort of came to the services after the goods-focused pandemic buying sprees. Does this imply that the goods inflation, the reinflation that we're seeing could continue because suddenly all of that demand is getting diverted back into goods after a brief hiatus that we're going to see come through this PPI and other readings going forward?
Well, I think that's a great question, and I do believe there's an element of that. If you look at some of the numbers, and I think Lisa was mentioning it, that it's amazing that investors kind of look through the CPI number and even last week's PCE number with regard to particularly what had been talked about by Jay Powell, no less, the core services ex-housing or super core inflation, which actually moved up on a month-over-month basis, and is still at 4.3 on the CPI core services ex-housing number, well above the kind of inflation readings that the Fed would like to see, because a big component of that is wages. And we just got an update from the Atlanta Federal Reserve with regard to their wage tracker that's showing that wages on a year-over-year basis flattened out in February at 5%, again, similar to that of January, which is, again, well above what corresponds to an inflation rate of 2%, which Jay Powell says earmarks closer to 3%. So I think perhaps some of this reflationary narrative is bleeding into some of these sectors. Now, there's also a tsunami of fiscal monies being leaked out of the CHIPS Act and the IRA Act that is helping to propel companies' profitability, particularly in the materials like cement companies and infrastructure build out here domestically. And defense spending obviously is benefiting from, unfortunately, the breakout in global tensions, which is not just the U.S. phenomenon, but a European one as well. And so that's helping to provide feedstock to those companies that propagate industrials and materials. But also, of course, we spoke of energy. But, you can also see it in some of the base metals that are percolating. Look at copper prices moving above $4 a share. Gold has certainly broke out to new all-time highs, but look at silver now breaking above $25. And even lithium looks like it's starting to form a bottom. So, collectively, some of this obviously is supply related, but it also may be indicative of perhaps a reflationary impulse that's starting to emerge, not only here in the United States, but also globally, which isn't to say we have to see a renewed bout of hyperinflation, but rather perhaps inflation may remain high and perhaps much stickier at levels above that which would otherwise might have been sort of treated as an expectation that its descent is going to continue linearly all the way down to 2% and stop.
Big focus on commodities. Mark, we've got to leave it there. Thank you, sir. Lots to think about. Mark Lashini there of Jenny Montgomery Scott. Katie Kaminsky, Alpha Simplex, talking about exactly the same thing yesterday. That's where she's focused.
This is what's in my mind right now. How long can that fiscal spending continue without some sort of commensurate reaction in the bond market? How long do you get that transfer from the government to all of these industries without people saying, oh, wait a second, where has the leverage shifted? And this is the reason why I like auctions. This is the reason why I care about this, even though I might be, 15 years too soon.
I've got an interview that you might like as well. Ken Rogoff, David Weston,
yes,
Wall Street Week. I knew you would. Reading your mind. Here's the quote from him to Weston. Washington in general has a very relaxed attitude towards debt that I think they're going to be very sorry about. It's not just the free lunch that Congress and perhaps the two presidential candidates have gotten used to. He doesn't know the upper limit of all of this, and nobody does. But ultimately, the base case is at some point, they're going to test it.
Well, we got data this week from the Treasury, $433 billion in the fiscal year so far because of interest costs. That's more than 40% that was spent the prior year. Paying off our debt is going to become in the next decade the top line of the U.S. budget. That's insane when you think about it.
Well, to me, the issue is going to be when there's true weakness. Where is the impulse of the U.S. to actually spend to support the economy? Because if you're borrowing into weakness, could you see a really much more difficult climb in benchmark rates? And that, I think, is really kind of where the rubber meets the road.
As soon as I saw that quote, I thought of you. Look out for Wall Street Week a little bit later this weekend with David Weston and Ken Rogoff. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The bill proposing a TikTok ban on U.S. app stores now heading to the Senate. This as China calls on the U.S. to stop, quote, unreasonably suppressing the app. In an exclusive interview with Bloomberg's Stephen Engel, U.S. Ambassador to China, Nicholas Burns, weighing in.
We've heard a number of complaints from the government here in Beijing this week about the American debate on TikTok. I find it supremely ironic because government officials here are using the X platform to criticize the United States. They don't give their own citizens the right to use X, to use Instagram, to use Facebook, to have access to Google. And so it is ironic indeed that the government here is complaining about a process when they shut down access for 1.4 billion Chinese to all of these platforms.
While investors await the highly anticipated Reddit IPO, the social media company is giving guidance on its expectations. Bloomberg News has learned Reddit is telling potential investors it expects revenue in 2024 to grow by more than 20% versus the previous year. According to its filing with the SEC in 2023, the company saw revenue come in at just over $800 million. Rents in Manhattan rose during a busy February for leasing. Median rent in February came in at just over $4,200. That's up 3.3% from a year ago. Overall, the number of new leases signed in February in Manhattan were up nearly 8% from last year. Rents typically drop during the winter months, but apartment prices are not letting up. That's your Bloomberg Brief. John?
Yahara, thank you. Just got a tweet. Do you see this? You'll like this. Okay, it's about you, Bramo.
Oh.
You seem stressed. You might need a vacation.
Well,
This is just how Lisa gets about the bond market.
Airfares are going up.
First-time viewer, Bramo.
It's pretty much, evergreen statement.
Up next on this program, the TikTok bill heading to the Senate.
I want to divest the Chinese Communist Party from our data, but here's the problem. If you shut down TikTok and there's no competition for Meta and Facebook and Google, they become the most dominant force in America.
That conversation just around the corner, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
That way I'm talking with.
No. Okay? No. We're not doing that. Equities right now on the S&P, positive by a third of 1%. Yields look like this. A 10-year, 4.1879. In foreign exchange, the euro, 109.40. Bramo, get it together. Under surveillance this morning, the TikTok bill heading to the Senate.
I want to divest the Chinese Communist Party from our data. That's going to require American sale. So I'm leaning yes, but here's the problem. If you shut down TikTok and there's no competition for Meta and Facebook and Google, they become the most dominant force in America. So I'd like to have somebody in the conservative world buy TikTok.
I love the end piece of that. We can get into that in just a moment. Here's the latest. The TikTok bill moving to the Senate after passing in the House by a wide majority. The app facing a U.S. ban unless its parent company ByteDance divests the platform. Brian Weiser of Madison & Wall estimating a ban would leave as much as $8 billion in ad revenue looking for a new home. He writes this: even if digital advertising continues its gradual deceleration towards industry-level growth rates in the coming years, next year could turn out to be a very good one for most digital sellers if a ban took effect. Brian, I'm pleased to say, is with us around the table. Brian, we've got to dance with a lot of what-ifs in the next 5 minutes or so forgive me. Because basically, we have no idea. If it gets to the Senate, if it passes the Senate, what happens next, all the legal challenges, etc. Can we just start here? Potential buyers, if they did divest this, do we know who they would be?
I can't actually imagine anyone realistically buying it. The only one big enough that doesn't have an antitrust problem potentially would be Microsoft, maybe. And even they have a big advertising business to start with. I think the most realistic scenario is if this passes, then we get to a situation where either China says, no, we're not going to let that happen. Or they do an IPO. They literally split off and independently operate. And I think those are the only two plausible scenarios. Pulling out of the U.S. is a very realistic situation.
Isn't it funny, though, the language you just used, and I want to pick up on it because I think it's deliberate and there's a meaning in there. You say China won't allow it, but ByteDance says they're not controlled by China.
Right, but the actual algorithms, the actual intellectual property, from everything I've read, is in fact controlled by Chinese governmental supporting entities. They need approvals to be able to do it.
Which is a reason why I think a lot of people are seeing it as basically a proxy war between the U.S. and China and questions around media dominance. I find it interesting about what Lindsey Graham said about a conservative buyer. Because to me, why don't we regulate social media platforms like media, like news outlets, if we're basically saying that the algorithm is going to determine whether it has a conservative or a liberal bent?
Yeah, well, I mean, I think the logic of this was always when it came to broadcast radio waves, right? The public environment, whatever that, could be regulated by the government. You could say foreign owners cannot own broadcast outlets, but foreigners could always own print. Right? They could own, there are media assets they could own. I think the bigger issue, though, is that is there a national security ground? Is there a reasonable basis for this? And I mean, that's why this isn't just a First Amendment issue.
Well, that's the thing. Rupert Murdoch became a U.S. citizen so he can take over a U.S. cable network. I mean, well, and also beyond that, also just the regular, not just cable, but also Wall Street Journal, et cetera. Can you see someone outside of the United States buying this?
The problem is there's no one big enough, right? And so it makes way more sense to think of TikTok as a standalone entity, and maybe there's a way to think about them licensing whatever intellectual property they need, or possibly just completely severing from any Beijing-based operations. But it's really hard to imagine that because it's so integral to what they do, right? The whole special sauce of the algorithm is developed by engineers in Beijing. So how do you really separate that? It's like separating the Ferrari engine from the Ferrari car.
But this goes back to what we heard from Brendan Carr yesterday, the FCC commissioner. It's not the content, it's the conduct.
Yep.
And if that's the case, then why would a First Amendment hold up in court? Why would that argument hold up?
I agree. I don't think it does hold up in court.
Let's get to your world, ad spend. Who benefits from this?
Well, it really depends on who takes advantage of the situation. Meaning, if there is, call it $8 billion in the U.S. alone, that would suddenly have to find a new home. Well, what I think would happen is the creators that make a lot of content that drives so much of the usage, they will look for new homes firstly. And so what really matters is, does a Snap, does an Instagram inside of Meta, does even a Reddit, do they start creating new creator deals to offer make it attractive for other creators to spend more time with those platforms? That will drive the money.
What's special about the creator deals at TikTok? What's unique about them?
It's just, who do you produce content for first, right? Who do you prioritize? If you're a creator, you make content on TikTok, you're doing it to the exclusion sometimes of doing it for Instagram or doing it for someone else. In the case of, say, YouTube, sometimes they have exclusive deals, right? In the case of a lot of platforms, they can have exclusive deals. That will drive who wins. So Snap could all of a sudden double its size if they all of a sudden said, here's $1 billion creator fund.
Are advertisers talking with their feet yet?
No.
In sort of anticipation of some sort of transaction?
I don't think that's happening at all. This has all happened too soon for the advertising industry to react, so firstly. But no, I mean, there's no reason why they would pull their money yet.
And there's no reason why they would stay away from the platform because of concerns over national security or other things, correct?
No.
But why too soon? I mean, I wrote about this last year, and before that, people have been writing about it since 2022, 2021. How is this too soon for advertisers?
Too soon in the sense of this legislation going through. Obviously blindsiding TikTok, but you have to think about advertisers allocating their budgets over much longer time horizons. I mean, months, most realistically. But the reality is that, okay, so there's a national security concern. Most advertisers say, and that's my problem, why? Now, we could argue they should, but that's not how they act.
Can we just get to the tensions between the US and China? Obviously, many of these social media platforms in the United States not operating in China, but China is still a source of revenue for them. There's a lot of ad buying going on. Is that breaking down? Is that under threat at all?
Not yet, and this is a big issue we've talked about before, right? This is around 10% or more of Meta's revenue comes from China, right? This is still not fully appreciated. And it's not just Timo and Shin. This is way broader than this. I've been on this for a decade. It's been growing, it's been bigger and bigger, it's been distorting a lot of the growth rates.
Even though they're not there?
Correct. Amazon also is probably seeing a similar amount of revenue from Chinese manufacturers spending money on advertising in markets outside of China. It's a big business.
This is Pete Shear's point about made in China and wanting to export all these goods. They want to advertise around the world, and where do they want to advertise? Where the eyeballs are. So it's sort of, does that get threatened, or ultimately does money win out in the bottom line?
Cross-border trade is a big part of this, right? So how does a Chinese government react? And again, let's not even get, or we can get into what happens if Trump's 60% tariffs are a thing.
Well, we don't have time this morning, Brian, but next time we can spend 10 minutes on it, maybe even longer. Brian, it's good to see you. Brian Weiser there of Madison and Wool. You can't sell BYD. You're not going to do the BYD commercials on Meta anymore, if there are any.
Exactly. And whether China will allow it, because does money win out there as much as it does in the U.S.?
Yeah. Economic data about 1 hour away, live from New York City. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocks are higher by about 1/3% on the S&P 500, rallying here on the Nasdaq as well after pulling back from all-time highs in yesterday's session, positive by 0.4% on the Nasdaq 100. Monday, Tuesday, Wednesday, starting the week with yields up every single day this week, with the exception of this morning. Let's switch up the board and get to the bond market. 2-year, 462.39, down about a basis point this morning. Started life this week, Lisa, in the 440s. On the 2-year, going into economic data through the week.
This is where the repricing has happened after CPI, right? People are slowly pushing back rate cuts, but it hasn't been dramatic. No one's basically freaking out and saying the sky is falling and yields have to shoot higher, the Fed has to hike rates. No one's saying anything particularly dramatic. It's just sort of, incrementally, things are good, so they won't cut as soon, and it's not going to be that big of a deal.
And that hasn't been at the expense of the equity market,
correct,
which is not where we thought we would be a few months out. A few months ago, looking out 2 months out.
It hasn't come at the expense of the equity market, and it hasn't come at the expense either of the credit markets of all types, despite some of the speculation that rates for higher for longer would lead to some sort of default wave. No one seems to care.
The spreads have been super tight. We'll talk about credit a little bit later this morning. Super tight even with tons of supply coming into the market to start 2024. We're talking about possibly record numbers. Under surveillance this morning, let's get to the top stories. A little under an hour away from a slew of US economic data with PPI retail sales and jobless claims due out at 8:30 Eastern. PPI particularly important as the last inflation read before the Fed meeting next week. A range of views on the street. Citi, Mizuho, B of A expecting a hotter read of 0.4% month on month. JP Morgan's David Kelly at the other end expecting a print of 0.1%. The split between JP Morgan Asset Management and Mizuho pretty revealing after CPI early this week.
I'm just waiting for the cookies to cool. We're just sitting around waiting for them to maybe get to a place where we can eat them. Look, if you missed it, go watch it. But to me, I'm just thinking around what will be enough to spur some sort of discomfort in this market, right? Will there be a level of inflation that makes people rethink how long the Fed really has to hold rates and maybe bring Torsten Slok's view a little bit more into the fore of potentially no rate cuts this year?
It's going to happen incrementally. We started the year with a big spread between the market and the Federal Reserve. We've closed that spread with the market coming towards the Federal Reserve. The Fed's going to reconvene next week. They'll plot their dots. They'll come up with a new median. Basically, most people assume it's going to look like the median that we got back in December, but it only takes a couple of policymakers on the FOMC for that 3 cuts this year to come down to 2. It wouldn't take a lot.
But you know what was interesting? People thought they were trying to be hawkish in some of their prognostications by only saying 3 cuts, and everyone said, we don't believe you. And now I wonder if them just saying, no, we were serious is enough for the market to say, wait a second. We have to rethink this. I mean, honestly, so what people take away, the messaging, the tea leaves, the sort of game theory with the Fed and the markets is endlessly fascinating.
Do you want some political theatre? Here it is. Donald Trump holding meetings with potential cabinet picks, considering billionaire John Paulson as a possible option for Treasury Secretary if he wins a second term in the White House. Other names in the mix include former U.S. Trade Representative Robert Lighthizer, billionaire Jeff Yass, According to Bloomberg's reporting, Trump publicly floating the possibility of Paulson serving after his win in New Hampshire in January, but a campaign spokesperson denied any discussions have taken place. Drip feed, drip, 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 through the next several months on this front.
Well, when it comes to John Paulson at this event in New Hampshire, Trump said he was a money machine. Guy makes money anywhere he goes. So, maybe we'll put him at Treasury. What I find interesting about our reporting is Jeff Yass, because it comes at a time that Trump has seemingly flip-flopped when it comes to TikTok. Jeff Yass is a huge Republican donor. This is Club for Growth kind of style. And he has billions of dollars invested in TikTok. Maybe this is the man he's floating to run the Treasury? Timing is interesting.
We'll see. Why won't Steve Mnuchin have another run at it?
Dealing with the New York
when it's over.
Bank.
You're done with this, aren't you, already?
I have no interest in the theater. Like, tell me who you actually want to nominate and who you actually want to have a policy, and I will pay attention. Line it up like Bachelor, not interested.
Until then, no interest at all.
I'll track it. But
There's a New Yorker cartoon yesterday that is two women, or I don't know, someone was underneath a blanket sitting on a couch. One is really grilled to the TV about the election. That would be me. And the other person is under a blanket and says, shall I take the blanket off when it's over?
Shouldn't assume it's a woman, Anne-Marie. That's rude. A bill that would lead to a possible ban of TikTok.
Really?
Gathering momentum. Passing a vote in the
I had
House
Lisa in mind.
and heading to the Senate. China calling on the US to stop, quote, unreasonably suppressing the app. But in an exclusive interview with Bloomberg's Stephen Engel, the US ambassador to China, Nicholas Burns, not backing down.
We see it this way. Technology is in many ways now at the heart of the competition between the United States and China, whether it's commercial technology, TikTok, for instance, or whether it's technology that can be transformed into military technology used to compete against us. And President Biden and our administration have been very clear, we're not going to allow the export of American technology to China that would compromise our national security.
The president has thrown his support behind the bill, while rival Donald Trump has suggested it shouldn't be banned. National security has come up repeatedly in the last 24 hours. Lisa's been talking about it. We all have. The fact that yesterday it was TikTok, this morning it's US Steel, and in the future it may well be Chinese EVs.
Well, yes, it has also come up, Jonathan, where you're deciding between national security or climate when it comes up with this administration putting a stop to some of the permits when it comes to LNG. When it comes to national security concerns, though, a lot of lawmakers are saying, Alexandria Ocasio-Cortez, that this wasn't outlined to the public. I really struggle with that. Avril Haines, the FBI director, the latest global report on national security concerns, all named TikTok. And if that's not worse enough, go back to December of 2022. The executives at ByteDance and TikTok even admitted that some of their employees at ByteDance actually tracked the IP addresses of users, including journalists who were critical of TikTok.
The
It's
we
obvious.
need more time argument is a little bit flaky, let's put it that way. Let's turn to credit. Iranian corporate debt gaining momentum despite fears of sticky inflation. Spreads on US high-yield bonds falling to their lowest since January 2022, even with markets pushing back rate cut expectations. Blue Owl is one of the beneficiaries of the credit boom, seeing its shares soar more than 70% over the last year. Mark Lipschutz, the co-CEO of Blue Owl, joins us now for more. Mark, good morning to you.
Good morning. Great to be here.
Let's talk about what's happening in the world of credit. So we had the rate shock last year, lasted about 5 minutes, some banks failed, we moved on really quickly. We started this year by thinking about commercial real estate, CRE, who's going to be next? Are we going to have this credit stress? Of the 350 portfolio companies that you're across, any distress whatsoever right now?
The portfolio is strong. The economy read through our portfolio looks quite positive. Certainly, wind back a year, and I imagine if we were all sitting here, I had the privilege of having this conversation with you a year ago, I think we'd probably all be talking about what type of recession would we be in right about now. And we're not. You know, I look across those 350 companies, and you look last quarter, our companies on average grew 15%, their EBITDA. So that is, now these are very selected. Obviously our job is to find great companies and to make loans to really strong businesses that have a lot of potential, a lot of growth, and where we can therefore have a lot of cushion in our loans. But nonetheless, if our portfolio is growing 15%, we are not in a recession nor on the edge of it. And we don't see the normal indicators yet that would suggest a meaningfully weakening economy.
Do you find that your portfolio companies can handle paying 10, 12, 14% interest rates and survive and thrive? Are the higher yields that we're talking about not restrictive based on the growth that they're projecting?
Cutting through it all, they're doing fine in that context. I think what we now know from we didn't know a year ago was this speculative question of, with rates rising to levels, of course, we hadn't seen in many people's working lives. They hadn't even experienced interest rates that had like a positive number to them. But in any case, at the end of the day, what we now know is we have a full year of those rates have run through the P&Ls of these companies. And I mean, of course, by definition, there's going to be an incremental company that will struggle more in a higher rate environment. But writ large, no, that has been absorbed by the system and quite successfully. We see it. We're not seeing these waves of changes or even the precursors to them, like asking for lots of amendments or meaningful changes in, hey, can I pay in more debt? Can I pick my interest instead of paying in cash? So the indicators that are not even just we would suggest an issue, kind of have to predate an issue, just aren't there in any meaningful degree yet.
Which is fascinating to me because we talk about, is it restrictive, and then have companies actually felt this? You're talking about floating rate note loans, so you're talking about companies that actually are handling higher benchmark rates now, not necessarily waiting to refinance. How has it affected the demand, given the fact that companies have seemed reluctant to borrow to fuel growth, given the higher rates?
So indeed, look, our specialty is senior secured floating rate debt. So to your point, this environment has been very good for us, good for our investors. It's raised on a quite quick basis the returns people earn. Of course, that's the point, to be inflation protected in our kind of product. So companies have absorbed that pretty successfully. People are borrowing capital. At the end of the day, again, of course, supply and demand, we all know more expensive capital means people are going to use perhaps less of it. But in the world of private equity in particular, in buying a company, and I started in private equity myself back in 1995, it wasn't even called private equity then. And at the end of the day, that cost of capital, it's a bit of a calculation, right? It's how much you can pay for that company. Of course, it reduces the value you can pay for an enterprise, but it really isn't prohibitive to conducting activity. What you really need is an environment where people have a common set of expectations. It's really more about the gap between buyer and seller in terms of their expectations than it is the absolute numbers.
Was it easy back in the 90s compared to now? Was there less competition? How different was it?
Well, it was a lot different, that is for sure, and there was certainly a lot less competition. If you look back to 1995, when I was lucky enough to join KKR, there were two large private equity firms, LBO firms, as called then, at the time, Forsman Little and KKR. The world now, we're talking thousands and trillions of dollars of capital.
Everyone wants a piece of this, and I think there's a worry that maybe it just ends up with people chasing the same deals, they're sloppy deals, and maybe the traditional lenders get squeezed out. Is that how you see things at all?
So the opportunity, by virtue of that evolution of the market, trillions of dollars of private equity, what we saw at Blue Owl was the opportunity to create the financing source to meet that need. Now, this is a very young industry comparatively. When we talk about that very point, thousands of private equity firms, amongst the folks that focus on the large area, we focus on the very largest financings, very largest companies. There's just a few of us. So it's a very young industry by that measure, and I think, therefore, a lot of opportunities ahead.
To his point, though, a lot of people would argue that we know what's going on with some of the public markets because basically you've seen the best and the brightest kind of weeded out and others kind of fall out of bed and maybe gone to the private markets. There's sort of this question of, is there some behavior that could lead to higher default rates that could be somewhat masked by the lack of transparency? Do you buy into that? Do you see colleagues that are operating with, say, maybe less or lower standards than yourself?
I believe that the private market has fundamentally added a stabilizing influence in total. Now, of course, again, you're going to have a dispersion of different participants. Some will do better than others. We're intensely focused on credit. That has been where we have lived. We've done about $90 billion in loans, and our running loss rate has been 6 basis points. So there really is a durability, but more important for the markets writ large, having a steady source of capital through ups and downs. During the pandemic, we were still providing capital. During the run on the regional banks, we were providing capital. When inflation was surging, we were still providing capital. So a healthy system is not one where private markets take over from the public markets, but it is one where you have a large, vibrant private market alongside a large, vibrant public market. That is a better economic platform.
You inked a pretty big deal last fall with Mubadala. Do you see more interest from some of these sovereign wealth firms, particularly in the Middle East?
We do. The private lending, direct lending was adopted, I'd say, generally speaking, earlier by U.S. institutions. And part of that, I think, is just the maturation to a degree from really 10 years ago. This flavor of direct lending, the lender of first choice, as opposed to lender of last resort, really didn't exist. So this is kind of a 10-year industry in that regard. And now we're seeing an increasing interest with non-U.S. investors. Part of it, I think, is now appreciating the durability. It's a so to speak, a safe haven. Where do you want to be when times are uncertain? You talked earlier about the dispersion of views. I think where you want to be is senior, secured, floating rate. So I think that the non-U.S. investors are appreciating that being a core holding. And at the same time, just look at the absolute returns. When you can generate double-digit returns, taking that very senior position, that very moderated risk, that absolute level of return starts to really resonate for people in non-U.S. markets as well.
Can I finish with a terrible question? Is there evidence whatsoever, any at all, that this Fed is sufficiently restrictive, based on what you see in your world specifically?
So here's what we see in our world. Inflation's a sticky animal. We saw it starting a year ago, and there's plenty of things. We're not macro prognosticators, but 350 companies looking bottom up, we continue to see inflation be sticky. There are offsets for sure. Look, shipping costs have come down dramatically. We have a consumer products company that was paying $20,000 a container. Now they're paying $3,500. But wages are sticky. Wages are still rising. So we are not through the teeth of this inflationary challenge. We're through the worst of it, but we're not done with it.
This was probably better to get your answer than ask another economist this morning. Mark, it's good to see you. Thank you, sir. Mark Lipschultz there of Blue Owl Capital. I think the answer, Bram, I think you heard the same one, right?
I mean, basically, no, because if we're looking at companies that can handle higher borrowing costs and are still hiring and still expanding, where's the restrictiveness?
It's pretty revealing. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The world's largest assembler of iPhones, Hon Hai, reporting a 33% jump in profit in the fourth quarter. But it wasn't iPhones powering that growth. Hon Hai saying they're seeing very strong demand from clients for AI hardware. The Taiwanese company also giving a bullish forecast for the year. Former CNN anchor Don Lemon said Elon Musk canceled their partnership for a new show on X. Lemon said he was informed of the decision just hours after he interviewed Musk. That interview is still set to air as the first episode of the Don Lemon Show next week, which Lemon says will now continue on other platforms. X had unveiled the show earlier this year as part of a new slate of video programming. And SpaceX is set to take another step forward in its Starship program. The window for the third major test flight for the massive rocket opens at 8 a.m. Eastern. Starship is the largest and most powerful rocket ever developed and has an ultimate goal of taking humans to Mars. The last two tests ended with explosions, with this launch hoping to approach orbit. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, Houthi attacks continuing to weigh on global shippers.
The Houthis have continued to launch these reckless attacks with no regard for the well-being of innocent civilians who are transiting through the Red Sea. And now they have unfortunately and tragically killed innocent civilians.
That story just around the corner.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Bloomberg.
Stocks doing okay, up a third of 1%. Data drops in about 42 minutes from now. Retail sales, PPI, jobless claims. You know the drill this morning. Yields unchanged on a 10-year, 419.38. Under surveillance this morning, Houthi attacks continuing to weigh on global shippers.
The Houthis have continued to launch these reckless attacks with no regard for the well-being of innocent civilians who are transiting through the Red Sea. And now they have unfortunately and tragically killed innocent civilians. And so the United States will continue to hold the Houthis accountable for their attacks.
Here's the latest this morning. Shares of Hapag-Lloyd lower in Germany after the shipping giant reported a decrease in earnings and warned of a further decrease in 2024 on a, quote, volatile and challenging economic and political environment, especially in view of the current situation around the Red Sea. Rolf Haben-Jansen, the CEO of Hapag-Lloyd, joins us now for more. Rolf, great to catch up with you, sir. I want to talk about freight rates. When freight rates first started picking up earlier this year on the back of this story, there was a sense from some people that maybe that was temporary. Do you see that as the new normal now? And ultimately, are they going higher?
I think we saw an initial reaction, was especially spot rates went up a lot because that's a combination of everybody then trying to book things quickly. We were running up to Chinese New Year and a lot of uncertainty. I think right now we see that the services are stabilizing, which means also that the market is getting calmer. And as a consequence of that, I think we also see spot rates in particular coming down.
Just how much time and investment has gone into finding alternative routes? Are you considering more land routes? Are they viable given the increase in rates that you've seen?
I mean, we have opened up a number of new land routes, and we've also taken on some additional ships. And of course, we've also had to buy a lot of additional containers because as all the voyages have become longer, we in reality also need more boxes to transport the same amount of cargo.
Rolf, how easy is it to pass along the extra cost associated with this to the shippers, to the consumers, to the companies that want to ship?
I think we see by and large that these costs are being passed on, and I think that's also reasonable. I mean, if you compare the situation now with what we had at COVID, there, of course, rates exploded. Today, you have a different situation because there was probably some spare capacity in the industry when this crisis hit us, and that has certainly helped us to keep global supply chains going and also to keep the increase in cost within reason.
So if there isn't any pushback, why are some of the profitabilities coming down? Just simply because if you can pass it along, are people shipping less? Are they looking to different routes that are shorter?
I think right now you are still looking at the results that come out on companies in the fourth quarter, where we had exceptionally low rates that were way below cost. That's also why a lot of companies posted losses. I think you will see a recovery in freight rates when you start looking at the first and second quarter. The question is, of course, what's going to happen once the situation around the Red Sea normalizes.
I want to talk about the situation in the Red Sea. The United States seems to be in a cycle of defense, not deterrence when it comes to their posture. Are you seeing any signs of deterrence from the United States or the UK or others when it comes to the Houthis?
Well, first of all, let me say that we really welcome all the efforts that are being undertaken by the U.S. and their allies to try and stabilize that situation. But of course, it's very difficult because it's a fairly large area that you need to defend. And then so far, we have seen that the attacks of the Houthis continue. And that also means that we will then decide we have no other choice than to keep our people safe, even if that means that some of the supply chains are then 7 or 10 days longer.
Well, what are governments telling you about securing the Red Sea? Do you have a timeline of when you think you could start using that route again?
I think there are many different opinions on when that is going to happen. I think we hope that we're going to be able to go back through in a couple of months. But I know there are also people that think that it may last quite a lot longer.
Rolf, thank you, sir, for the update. We appreciate it. It's an important story, has been for the last few months. Rolf Haben-Jansen there, the Hapag-Lloyd CEO. Looking at this, AMH, we thought we could deal with this quickly. We didn't. We can talk about the inability of allies of the United States to basically reopen this important trade channel. It hasn't happened. Freight rates have gone up. We thought that might be temporary. Based on that conversation, that doesn't sound temporary at all.
It doesn't, and what they're going to have to do is put more money into those vessels, and those vessels take a lot longer in the direction of travel where they're going around the Horn of Africa, the gasoline, and then he also said there, the cost this is now going to those businesses is now trickling down to the consumer. And this is what we heard from the UK Chamber of Commerce as well.
The fact that they're able to pass along the cost, though, gives me sort of this real question, which is basically, how much does that affect prices? Is this just a European issue? Then does that basically take the onus off the U.S. to really defend? Is that part of the reason why there isn't more aggressive action in the Red Sea? But then also, from their earnings perspective, why wouldn't it be a good time then? Because it's kind of going back to freight rates being higher and people accepting it.
What did David Rosenberg say of Rosenberg Research earlier this week? He said there is CPI world and then there's the real world. The real world around this table in the last 10 minutes is a very different real world to the world we were talking to him about. We've just spoken to someone across 350 portfolio companies who just basically said that rates aren't hurting them and inflation is sticky. And that conversation, and I know, and you can use the I word for that conversation, of course it's idiosyncratic, but it speaks to a broader story as well. You hear sticky inflation right there too.
And you hear that people are able to absorb it. That's the key. It's not difficult for them to pass it along to the companies because they're willing to pay it because they need the goods, because there's the demand for it. And that's the ultimate underlying point.
Besides the security concerns in the Red Sea and the Gulf of Aden, if inflation is still what is hurting this administration and this campaign in their polls, you'd think they would take a more aggressive posture when it comes to deterrence of the Houthis, not what we've really seen, which is pretty much just a defensive one.
That's the latest in the Middle East. I just want to set the stage with you for the rest of this morning. So equities at the moment on the S&P 500 positive by, let's call it 1/3%. In the bond market at the front end, Monday, Tuesday, Wednesday yields up. This morning, a little bit lower, 463 on a 2-year, on a 10-year, 419. As we go into a big hour ahead, Lisa, a lot of economic data, PPI, retail sales, and jobless claims. Take your pick, really, but for Julia Coronado a little bit earlier, there's pieces of PPI that go into PCE that could shape the conversation at the Federal Reserve a week away.
Airplane tickets. It all comes down to airplane tickets. I mean, there's some other components too here, but when we talk about the I word, let's talk about idiosyncratic. There are so many interesting stories, but they're all pointing in the same direction. The idiosyncratic story of airplane tickets, the idea that they're going up maybe because of Boeing not shipping as many of their planes, the idea that you're getting some of the increase in baseline gas costs. You know, you just have to wonder, when does that actually start to trickle out?
Coming up, Anastasia Anamoto of iCapital. She's going to be talking about some of these themes. Wells Fargo economist Jay Bryson, Bloomberg's Michael Shepard, and a conversation you do not want to miss. Colin Langan of Wells Fargo making some headlines in the last 24 hours, downgrading Tesla, a growth company with no growth. Lisa, difficult day yesterday for the stock. Difficult again this morning.
Difficult year for the stock, and how long can that continue?
Live from New York City, the third hour of Bloomberg Surveillance, up next.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, you know, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Look at the bigger picture. The broader trends in inflation and core are moving down.
Most people are not anticipating a re-hiking cycle or a re-acceleration in inflation.
Ultimately, after what we went through, I'm just happy that tightening's over.
There's plenty of time to see how the balance between growth and inflation plays out.
The economy is on a cooling path, but it's a very gradual path. There have been a lot of tailwinds for the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Horder.
The most important hour of this morning begins right now, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, your equity market on the S&P 500, positive 1/3%. We are 30 minutes away, call it 29, from PPI, jobless claims, and retail sales. The last big slate of data, Bramo, going into the Fed next week.
Will it change anything? Does it have to change anything for the Federal Reserve? Ultimately, I want to see if the market cares, how much people start to realize, wait a second, there's something that's greater and stronger under the hood here than perhaps we're pricing in.
The risk event, maybe there's two. They're going to have a conversation about a balance sheet, doing something about QT. That was flagged at the last meeting by Chairman Powell. I think the risk event for a lot of economists on Wall Street is whether those three dots, those three cuts, implied by the median dot at the Federal Reserve, drops down to 2. We go from 3 to 2, and which would drag the market maybe in the direction this market didn't want to go in at the start of the year.
That, and if Jay Powell comes out and doesn't sound quite as rosy about everything, maybe seems concerned about the fact that financial conditions have eased so much. Ultimately, a lot of people say the reason why equity markets just don't care about inflation staying sticky is because they know the Fed wants to cut, the Fed will cut, and therefore it will keep this party going.
And then what happens when Jay Powell comes out, potentially, if this is sticky, and then not just down to 3 to 2, but if he has to push it back in the timeline. And then I'm interested in that, because then what does that mean for November? Does he cut before the election? Does he wait till potentially after?
Let's set up the next 60 minutes. That's not the only story we'll be talking about. We'll be talking about Tesla as well. That is down by 1.4% in the pre-market. Yesterday it was a whole lot lower. There was a downgrade from an analyst over at Wells Fargo. We'll be catching up with him in about 45 minutes' time. Off the back of this story, Lisa, that ultimately there is no growth. A growth company with no growth. How do you value that company if that's the backdrop?
A lot lower than you did yesterday and the day before and a year before, which is exactly what we've seen with this basically being kicked out of the Mag 7, right? I mean, essentially, it's been kicked out of the club this year and last year, and now we're looking at a question of, is this just a pause, or is this a shift where people have to reassess the profitability of the electric vehicle transition?
This is not just low growth. I'm going through the note again. No growth this year, Anne-Marie, negative volume growth next year.
Well, the issue as well is just the broader EV market, and that's worldwide. Sales are down. And then you look at China, where Tesla wants to be selling. They have steep competition when it comes to BYD. BYD's the homegrown viral in China sells a model price for less than $10,000. How do you compete with that?
This has been the story the last few months. This is not new. This is where the market has been going, towards hybrids. Toyota, absolutely flying. Pure EVs, Tesla, suffering. If this is where the market is now, I want to think about the next stage of this. Is this where the market's going to be for the next several years? Southside's playing catch up, it's caught up. This is where we are. We're all on the same page. This is consensus now. This is the market. Hybrids. Is that where it's going to be in the next couple of years?
A lot of people say it's deferred, it's not delayed, not deferred, right? This idea that we're going to get there eventually. But it goes to your question, how do we price this in? I've never known how you price Tesla. Is it a tech company? Is it a car company? And ultimately, there are some key questions about how you can sort of effectuate the AI dream through the car if people aren't buying the car. So this is ultimately kind of a key question going forward that I am not going to weigh in on.
And then you've got the cult of Elon premium in the stock as well.
And you can send your hate mail to my inbox for mentioning his name.
Does that go into the junk?
No, I like to read all of it. I read all of the hate mail.
You like to suffer, don't you?
I do.
That's what it's about.
This goes deep.
Tesla, slightly negative in the pre-market. Coming up later, Colin Langan of Wells Fargo. Looking forward to that. Equity futures right now on the S&P 500, positive by 1/3% on the S&P. In the bond market, shaping up as follows. A 10-year yield just about unchanged, 4.1919. Coming up this hour, we'll catch up with iCapital's Anastasia Amoroso on why she thinks markets are in a sweet spot. Bloomberg's Michael Shepard on Biden's pushback against the U.S. steel takeover. And Jay Bryson of Wells Fargo on his June rate cut call and whether that is under threat. We begin with our top story. Stocks pausing ahead of the final inflation report before next week's Fed decision. iCapital's Anastasia Amoroso saying this: since January, we have largely seen economic data come in well above expectations, namely jobs and inflation data, supporting the view that the economy could be experiencing a re-acceleration or no landing. Despite the fears of overheating, we have seen data start to cool from the torrid pace at the start of the year, indicating that the economy may be operating in a sweet spot. Anastasia joins us now for more. Anastasia, good morning. It's great to see you, as always.
Good morning.
Is this why you're still constructive on this equity market?
That's right. I mean, the sweet spot is exactly how I characterize these equity markets because, you know, what happens, John, when you have good economic data, the markets inevitably cheer that because good economic data is good for earnings, is good for revenues, is good for profit margins. And one of the things that we have seen this year, as the economy is stable and accelerating, we've also seen the earnings growth expectations are also stable and actually firmed up a little bit. So that's why I think the markets have been able to push back the rate cuts and still move higher. But then on the flip side, you know, if we do get bad economic data, well, guess what? The consensus is immediately going to jump in and say, well, that means the Fed has to cut rates. So whether it's economic growth, whether it's rate cuts, but that's to me why the market is in a sweet spot.
So good news, bad news, good news.
Exactly. A lot of good news in there. Yes.
Basically, and equities keep on ripping. Can you talk to me about the part of the stock market you still like? Do like? Is it still the big leaders, the winners, big tech, or are you shifting elsewhere?
Definitely like some of the big leaders, and during the break we were talking about, or I guess before the segment, we were talking about how maybe Tesla's out of the Magnificent Seven, but you know, you definitely do like parts of the Magnificent Seven that are related to artificial intelligence and are actually delivering on that. But I think the other interesting story, John, is that there is a broadening out that is happening in the market, and I do like the cyclical straight. So one thing that stands out in particular is industrials. Maybe very quietly, but under the surface, you are seeing a lot of firming in the manufacturing space. You saw a big uptick in new orders for ISM manufacturing. We gave a little bit of that back last month. But when I look at the global manufacturing index, it is back above 50. It is the strongest level that we've seen in about a year and a half. And it's not just one country. You know, it's China, it's India, it's Brazil, and it's a lot of other countries that are participating in this manufacturing uptick. So that's why industrials have been strong so far year to date. And when you look at hedge fund flows, they are going into industrials. So I like sticking with AI. I like sticking with some of the tech leaders, but I do think that it is also time to add some of the cyclicality to the market as well.
When I go home today, I'm going to look up Google searches of sweet spot and Goldilocks and see just how much it's surged. How long can we stay in this sort of everything is awesome, buy everything, ignore the data, it's all good?
Yeah, I mean, If the Fed starts to materially push back on rate cuts, and if it looks like we may not be getting rate cuts this year, I think that's when you start to have to worry. Because Lisa, you'll probably remember the last time I joined you in December, I talked about the size of the debt pile. Whether it's the U.S. government debt or the corporate debt, and it's fine if it has to be refinanced at lower interest rates as the year progresses. But if it still has to be refinanced at 5.5% as the year progresses, I do think that debt burden starts to build and accumulate. So I don't think we get to that. I think the Fed ultimately does cut before that, but I guess that would be the pivot point to where I'd worry.
Which is the reason why I think a lot of people are saying, out there, we can worry about it later because it's probably not going to come to pass. When you talk to investors all around the world, when you travel in the U.S., are people concerned about downside risk? Or are they concerned, to Mandy Zhu's point, of not getting the upside risk that could be where volatility is headed?
Yeah. Well, it's interesting. There are two ways that I have to answer the question. I was at a presentation earlier in California this week, and I did actually do a survey of the room. It was a sizable room, and most people were bullish. Most people kind of agreed with the bullish consensus. And the question that I posed, consensus for analysts out there is 5,000. That's the target for the end of the year. So the survey of the room was definitely much more constructive than that. So I think most people are participating in this market. But on the flip side, we do quite a bit of structured investments for our clients, and a lot of our structured investment advisors are asking for additional protection on some of the structured investments they're doing, meaning they're asking for not just a 10% downside buffer, but maybe something more than that. So I think it really depends on what, how you've participated or not in the market last year. If you were sitting largely in cash, then you are probably playing catch up right now. But if you did really well in the tech trade, you might actually be looking to de-risk some of that by adding some of those additional buffers.
Which is kind of what we've seen recently. We've seen the NASDAQ 100 underperform some of the equal weight, et cetera. And I'm just wondering, do you buy this idea, well, we have gotten a little frothy, we like the trade long term, but it could pull back 6%? I mean, that's basically what we've been hearing from every analyst about the tech
NASDAQ trade.
Yeah, the NASDAQ trade. Is that basically where you are too?
Yeah, yeah, I think I'd have to agree with the consensus there. Look, if you look at every single technical indicator, depending on the stock, we have seen some overstretched positioning there. We've seen some overstretched momentum. So you'll probably have a catalyst to consolidate some of that. But, if you look at the AI trade long term, this is a multi-year opportunity. This is close to a $1 trillion total addressable market by 2026 that I think most analysts are still modeling conservatively. The reason why, and I'm using NVIDIA as purely as an example, but the reason why, NVIDIA has been able to, top estimates because analysts are only penciling in what they can see for the next couple of quarters, but they're not really modeling in the true $1 trillion TAM into 2026. But as that comes into view, and the analysts and companies deliver, and the analysts kind of reset those expectations, that's what gives you the upside. So I would say, even if you look at some of the price targets for some of the tech stocks today, maybe they're a little bit more modest today because stocks have rallied, but that's not a ceiling. That's just sort of a starting point.
In your latest note, you actually start looking at the election, and you say the market already is pricing in a winner. Who and why?
Yeah, I mean, it's actually clear from market data that the market is pricing a Republican win. And obviously, if you looked at the polling data, if you look at the predicted odds, for example, the former President Trump does appear to be in the lead. And since October of 2023, you've seen various types of Republican baskets from various banks outperform by a wide margin the Democratic baskets or the Republican underperformers. And, that might have something to do. I think part of it has to do with the election odds, but I also do think the composition of the baskets are more cyclical for a Republican basket. You're looking at things like financials, things like industrials, things like energy and materials. And so, it does have a high correlation with the S&P. But if you look at hedge fund positioning, once again, for example, in the Republican basket, you are seeing longs being added to the Republican longs and the opposite for the Democratic basket.
So do you think that's correlation or causation? What do you think that is?
I think it's a little bit of both. Look, I think the primary reason for why the Republican basket is outperforming is because of that cyclical momentum. So, I think that's more of a correlation. But But I do think that there's a part of the investment community out there that is positioning for election outcomes. And what a great way to position if that's the outcome that you're trying to position for, which is get the cyclicality in the portfolio, which is sort of right with the momentum of the economy and the market. And it also has the potential to benefit from a Republican win. Now, on the flip side, the Democratic baskets, they're pretty concentrated, and there's a lot of EVs in there. There's a lot of clean energy in there. So, you know, is it purely because of the odds of President Biden not being reelected, or is it really more fundamental and the outlook being more mixed for those?
Really interesting stuff. Anastasia, fantastic as always. Good to see you. Anastasia Amoroso there of iCapital. Just got a note from Citi, Andrew Hoddenhorst. Retail sales, haven't talked about that nearly enough. Lisa, you were touching on it. This is what he's got to say on retail sales this morning. If the control group is expected by us and consensus to increase after a large decline in January and then doesn't, if we're wrong, a second consecutive decline would raise recession concerns. Haven't heard much of that chat at all.
The R word? I mean, we're talking about sweet spot and Goldilocks. This is a question, right? If we start to see people stop buying, it's a big if, and it sort of goes against what we're hearing anecdotally from companies, that could be a real problem, potentially on the downside.
The data, 17 minutes away. Equity futures right now near session highs, up a third of 1%. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. A bill aimed at forcing a sale of TikTok is moving forward on Capitol Hill. The House passed the TikTok divestment bill by a vote of 352 to 65. It now heads to the Senate, where its prospects are less clear. Majority Leader Chuck Schumer has only said he'll review the bill, and members, including Republican Rand Paul, have come out against it. While investors await the highly anticipated Reddit IPO, the social media company is giving guidance on its expectations. Bloomberg News has learned Reddit is telling potential investors it expects revenue in 2024 to grow by more than 20% versus the previous year. According to its filing with the SEC in 2023, the company saw revenue come in at just over $800 million. Disney is making a push to find a successor to CEO Bob Iger. The board is focusing on the leaders of 4 different divisions. This happening as Disney is embroiled in a bitter proxy fight with billionaire activist investor Nelson Peltz. Iger's contract runs through the end of 2026. No decision on his successor is expected this year. That's your Bloomberg Brief. John?
Yahara, thank you. Just a quick update on Tesla. UBS, price target cut to 165, down from 225. Few reasons for it. Let me share about 3 of them. Revision is driven by slower demand in Western countries, intense competition in China. We now assume very limited Model 2 units in 25, pushing any meaningful volume to start in 2026. We'll pick up on that a little bit later. That stock is down 1.5%. Up next on the program, Biden backing U.S. steel.
We know we have to reshore, and we have to be self-sufficient. We have to be resilient. That doesn't mean we can't have partners, but we need to be able to do things here first.
That conversation up next.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Every weekday, only on Bloomberg Television. Context changes everything. Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
Equity futures on the S&P 500 up a third of 1%. Yields unchanged, 419.38. The data about 12 minutes away. Under surveillance this morning, Biden backing U.S. Steel.
This is one of those bipartisan things on trade. They fully understand how important manufacturing now is to the United States of America. And if you look at just the challenges that we had during the pandemic, where we couldn't get basic things, virtually every industry that we serve struggled because they couldn't get parts from other parts of the world. So we know we have to reshore, and we have to be self-sufficient. We have to be resilient. That doesn't mean we can't have partners, but we need to be able to do things here first.
It's the latest this morning. President Biden releasing a statement opposing the potential takeover of U.S. Steel by Japanese firm Nippon Steel. Biden saying this morning: "It is important that we maintain strong American steel companies powered by American steel workers. I told our steel workers I have their backs, and I meant it. U.S. Steel has been an iconic American steel company for more than a century, and it is vital for it to remain an American steel company that is domestically owned and operated." Biden's pushback coming as the campaigns in Rust Belt states for union and blue-collar votes critical for his re-election bid. Bloomberg's Michael Shepard joins us now for more. Shep, national security risk dominating policy efforts in Washington. It was TikTok yesterday, U.S. Steel this morning, Chinese EVs about a week or so ago. Where is this effort ultimately going into November?
Well, it's a great question, Jonathan, because we're seeing various threads all come together. We heard the U.S. Steel CEO talking about the importance of supply lines and supply chains separately when it comes to EVs and TikTok, which we saw the big vote in the House yesterday. There's a question concerning data. All these roads point back to China, though, because, you know, the underlying tensions between the world's largest and second largest economies remain. And the U.S. is concerned about making sure that Americans' data and privacy and national security are protected, and supply chains are too.
Michael, if everything's a national security risk, are we diminishing the meaning of national security?
Well, you know, at a time that we're also seeing Russia making gains on the battlefield in Ukraine, and this battle to win the hearts and minds of the global South, everything acquires an additional level of importance, and people are much more fundamentally aware of how all these things fit together, especially after the pandemic, when we saw supply chains pinched and the effects felt here at home. So it may not look like a national security question in the traditional military defense sphere, yet there is an economic security question that's just as important, and that hits home here pretty directly when things go sour.
Japan was also worried when the U.S. paused the LNG export approvals. Now Japan is concerned because of what's going on with U.S. Steel. Is this administration putting election politics over its firm allies?
Well, and I'm glad you asked that, Anne-Marie, because as you know, in a few weeks, the Japanese Prime Minister will be visiting Washington for a state visit. And this will be an awkward moment for him with the president, because obviously Nippon Steel, an important manufacturer back home for Japan, but they are buying an iconic American firm. Biden used that word in his statement, and I'm glad you were able to show that for viewers. There was so much to unpack in what Biden was saying, because he is addressing U.S. Steel status. Even in a non-election year, this would be a tough deal to get through. If Trump were in office, he has said he would block it immediately. And I think it would be tough for Biden to do even in an off year, because remember, he was born in Pennsylvania. He has ties to this area. U.S. Steel is from Pittsburgh. So for Biden, there is that. add the election year and it becomes even harder, especially as Trump and Biden are vying for the union vote and trying to win in these swing states, especially Pennsylvania, but also Michigan and Wisconsin. The three of them make up the so.
He was in Wisconsin yesterday. He's going to Michigan today. He's from Pennsylvania. Can he win without the blue wall?
You know, the Democrats maintain that they have several paths to victory. It will be difficult. It will require him to win the other 4 swing states, including Arizona, Georgia, and North Carolina. So this would be a much tougher road to hoe for him if he doesn't prevail in these 3 places. Remember, in 2016, Trump swept them. And then in 2020, Biden turned around and swept those 3.
Hey, Shep, great to hear from you. Michael Shepard, just a busy, busy time down in Washington, D.C. on this front. Lisa, you were the first to identify it this morning. Everything seems to be a national security risk.
I'm actually looking up people who are specialists in national security. I want to talk with them about how this is unprecedented or not.
Are they hiring?
Well, can I please go talk about national security, because everything's going to become national security. This is really a key question. Does it lose meaning? You asked it well. Does it lose meaning if it's being used for everything, and if it's being conflated with trying to keep business at home and trying to cater to certain union types of interests?
But this is my issue. Everything is national security until it's not. Look at what happened with the LNG permits. They decided to actually lean into climate and electoral politics and not national security. But national security is useful, say, for trying to shore up these supply chains, which, by the way, Nippon Steel only has about 5% of its production in China. I'm not really quite sure what the national security concern is exactly. Election politics play out.
When's the election in November? What day?
November, it's the 5th.
The 5th. So the 6th, that's when everything is no longer a national security risk. Is that what we're saying?
This is my frustration. There are some legitimate questions here. If we can't agree on the facts and the facts are getting conflated with other things, does it muddy the conversation and make it very difficult to parse the fact from the fiction?
Mike McKee wants to talk about the national security risk of retail sales that drop in about 6 minutes' time. He joins us around the table. PPI, retail sales, jobless claims, Mike, all coming up.
I'm shocked listening to you that politics is going on in Washington, D.C. I mean, how amazing.
Shocking.
Well, the politics does play into the retail sales and PPI numbers because, of course, it's all about the economy. I don't know there's a national security interest in any of these data, but catch me for GDP, we'll look at defense spending. But right now we're looking at a strong rebound in PPI is what's forecast, a lot of weather effects in January, and the PPI is expected to stay about unchanged, but it'll be interesting to see the categories that move because of some of this feeds into PCE, which obviously the Fed cares about.
Which pieces of this, Julia Coronado mentioned this a little bit earlier this morning, which pieces of PPI are important for PCE in this Fed?
Portfolio management, we've talked about that on the PCE day, about how much that's added to PCE inflation. Also insurance. And that's an interesting thing because that has come up politically in Washington, is the cost of auto insurance, house insurance, life insurance, everything is going up very, very fast. And people are wondering, you know, what's going on with the insurance companies here and how are they getting away with this?
Our lives are just worth more. I think that's the reason why.
Well said, Lisa. That's beautiful.
Thank you.
It's not about being ripped off. We're just more valuable.
100%.
Love that.
Thank you.
My premium's higher than your premium.
Yeah, exactly. Start talking about that.
You should campaign on that, promo. Your insurance is up, we're all worth more. It's beautiful. Up next on the programme, who are you? PPI, retail sales, jobless claims up next. Jay Bryson of Wells Fargo joining us in a moment. Where's Bramo?
Well, she's coming back.
Today, I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
From the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurize the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I want it to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the Gel Razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
$1,794,000. So the narrative that it's getting harder to